A dovish Fed narrative taking hold in the bond market. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. You take a look at where markets stand with about 2 hours to go. We're looking at another up day. The S&P 500 rallying about 0.7%. That would be the third straight day of gains. Same too, if you take a look at big tech, the Nasdaq 100 also up about 0.7%. As the bond market continues to rally here, you take a look at 10-year yields down a whopping 14 basis points. Of course, bond markets were closed yesterday, so a lot of that is that action from yesterday coming in, that haven bid expressing itself, along with those dovish Fed comments. And you take a look at oil. Of course, we had a big move yesterday after the Hamas attack on Israel over the weekend. We're down a little bit today, but still holding a lot of those gains. Currently crude at $86 a barrel.
Yeah, absolutely. Let's talk a little bit more about the bond market. It did reopen here in the U.S. following that Monday holiday. And the trade on this Tuesday, it's been strong. Prices surging, pushing the benchmark 10-year Treasury yield towards its biggest one-day decline, going back to at least March 22nd. Less hawkish Fed speak that indicates less of a chance for another rate hike, combined with that haven demand bid sparked by the Israeli-Hamas conflict. Still, some of this dovish dream by investors may actually prove to be just a little bit of wishful thinking. Remember, the Fed rate increases have so far failed to bring inflation back down to that 2% target. The U.S. economy is still resilient, and there's still massive concern out there about a massive supply of Treasury issuance needed to fund widening government deficits. Over the next 48 hours, we are going to get some monthly updates on U.S. producer and consumer inflation reports that are likely to show the Fed's fight against price pressures far from over. Energy and transport costs likely continued to boost producer prices in September overall, though core PPI did show some modicum of stability. The PPI report that comes on Wednesday morning, the consumer price index hits on Thursday, and it's likely to show a second straight month of core inflation creeping up to a pace that's more consistent with 3 to 4% annualized inflation, not that 2% target. That means the next Fed decision is no slam dunk. Anna Wong and her team at Bloomberg Economics see risk for that November 1st decision almost evenly balanced between holding rates steady or hiking again, with the odds slightly favoring a hold. You just saw Katie Greifeld stepping into the shot there, Katie, so let's go right to it. The IMF says it hopes the Fed and other central banks keep policy tight until there's a durable easing in price pressures. The IMF kicking off its semi-annual meeting this week in Morocco, saying it foresees global inflation remaining above central bank targets until 2025.
Well, Romaine, I was just so excited to bring you this chart because even though that's what the IMF said, you take a look at what's priced in when it comes to the Fed's monetary policy, and traders pretty much think we're done. You can see the upper bound is at about 5.5% right now. Traders pricing in maybe just 7 basis points ahead of that for where the terminal rate is. So really not too much movement. Of course, that's not even a full hike. And even though markets saying we're pretty much done when it comes to the Fed, bond market volatility has been through the roof, especially compared to equities. You're taking a look at TLT rate here. And of course, this is that long dated Treasury ETF. You compare its realized volatility in blue to what we're seeing out of SPY, which of course tracks the S&P 500. TLT has actually surpassed SPY in terms of the volatility. Now, as you can see, typically it's the other way around. How long this dynamic holds is an open question, but we know, of course, the bond market has been the epicenter of all the action.
Yeah, certainly so here. What investors are focused on here as we round into the last 2 hours of trading here on this Tuesday afternoon. Let's get some insights out of Alifia Doriwala, RockCreek Group's Co-Chief Investment Officer, here to help kick us off to the close. Great to have you here in studio.
Thank you for having me.
I am curious about sentiment surrounding economic conditions right now. We've kind of had this pendulum swing back and forth from the worst case scenarios, we're headed for a recession, to then the soft landing, and now it seems no one's really quite sure where we're headed.
Yeah, I mean, I think the mantra for investors is really higher for longer, and what medium-term implications does that have, right? I think if you're an investor today, you know, we invest on behalf of endowments, foundations, we have a long-term view, but in the short and medium term, we really need to be looking at how do you position an institutional portfolio for an environment that's going to be higher for longer.
Why do you think so many people are scared of that? I mean, I know that may be a dumb question, but every time you go back through history, long-term history, we've had these periods before where you've had elevated rates, including right where we are, 5-6% range here, and still had some pretty dynamic gains in the stock market and other risk assets.
I think investors and markets tend to have a short-term kind of memory, right? And I think if you have mortgage rates approaching 7.5%, 8%, that's an environment that we really haven't seen for such a long period of time. And portfolios and investors got complacent, right? They had easy money. We had equity markets continuing to go up. It was fairly easy to be able to manage a portfolio within the conditions that we had. We didn't even have as many geopolitical tensions as we do now. If you think of China and obviously the tragedy that's happened over the weekend. And so I think that really investors are not used to this new norm. That could be a new norm for the last quarter of this year and surely into next year.
Surely into next year. And I mean, when you think about that setup heading into next year, that rates are extremely high right now. We haven't really seen that widespread sort of translation into the broader economy. What economy does that send us into? Is it sort of a rolling downturn where we see parts of the economy buckle where still other parts are resilient?
I think that's a great point because I think we're going to see a sluggish economy. The economy is resilient, especially in the U.S. relative to other global economic markets. And so I think in the U.S. we're going to start to see a sluggish growth, and that has implications. And if you think about the stronger dollar, right, that's a factor that we haven't really talked about as much, but that's going to weigh and drag on equity markets. So there's going to be a lot more headwinds heading into next year. And I think to your point, the lagged effect of real estate and of the implications from higher interest rates on so many different sectors have not really been felt yet.
So how do you position around that? Are you staying defensive? Is that the sort of characteristic of your portfolio, or are there still places where you're trying to play offense, where you're trying to find alpha?
I'd say we've kind of shifted the second half of this year into a much more cautious stance, but that means you have to be flexible and nimble because you don't want to miss opportunities that will appear early next year as maybe we start to see a little bit of a bottoming out, at least in sectors that we've already seen some pain. So we have to be ready to be able to make investments, take advantage, play offense, make money for our investors, but again, with a cautious stance.
I'm curious as to how much more difficult that's gotten, mainly because when you go back to the easy money era, I mean, it was called the easy money era for a reason, but also there wasn't a whole lot of competition in terms of if you were looking for a return yield, even on a risk-adjusted basis. It was very clear where you needed to go. Right now, I can go into the Treasury market, get 5% relatively riskless. I can even go into corporate fixed income and the investment grade side, get more than that relatively riskless here. I mean, what is sort of, I guess, the case to be made for anyone venturing deeper into risk assets at this point?
No, and it's a great question because we look at the risk-return trade-off of any risk asset today because to your point, do we otherwise just play it safe and keep it in a slightly lower returning asset? And so our hurdles have just gotten so much higher for any investment across asset classes, right? We play in alternatives, private equity, venture, even longer term. You're going to have and be paid for taking that risk, and that hurdle has just increased and increases, quite frankly, every day when you look at bond markets.
I'm just curious, just to follow up on that, particularly when it comes to private investments. Are you finding that the private equity and private capital firms, I should say overall, that they have finally come to terms with that? Because I felt like maybe a few months ago they were still in kind of denial about the fact that their hurdle rate was needed to be higher.
Well, private equity investors have the luxury of saying 10 years out, 15 years out, right? So I think there is a realization that in the next 2 to 3 years, the type of investments they're going to have to make and their own risk analysis for what type of investments they're making has to change in terms of this new norm. Whether they're really looking out 10, 15 years, if that's going to affect their returns, I don't know. But I think in the medium term, it's at least brought a normalization to valuations, or will start to.
As a data-driven journalist, talking about the private equity, the private credit world, it's kind of frustrating because obviously it's private. I can't see immediately what's going on tick by tick. What's the best proxy for how things are looking there? I've heard it's high-yield spread. Some people tell me look at small-cap tech stocks. What's the best sort of, temperature check to see what's going on in the private world?
Unfortunately, especially if you're data-driven, I think there is a lack of data. And to a certain extent, transparency, as much as we demand transparency in terms of our investments, there is a bit of a lack of transparency. But I do think that if you are looking at other proxies, again, you have to look at what are you getting in public equities, knowing that you have a lagged effect in privates, and then what should you be getting? We saw a lot more difficulty in venture and some of the asset subsectors within private equity just this last quarter because of the lagged effect, right, from public equities, which we saw at this end of last year. And so I do think that the public equity market is still a good proxy for what you should expect, knowing that there is this time arbitrage.
All right, Alifia, this is great to talk to you, and I think this is the first time we've had you in the studio in ages, at least on our show here, which, by the way, is the #1 show. Alifia Doriwala over at the RockCreek Group, helping us to kick us off to the close here on this Monday afternoon. Of course, all eyes are still on what's going on in the Middle East as the death toll growing in Israel's war with Hamas. As the conflict continues here for a fourth day, no resolution in sight. We're awaiting word now from the President of the United States on what type of support the U.S. will provide.
Plus, oil steadies after the biggest jump in 6 months. We'll take a closer look at how an extended conflict in the Middle East could affect the markets.
And interesting developments out of China. Some speculation right now that it's considering raising its budget deficit as the government prepares to unleash a new round of stimulus to help the economy. The reaction by investors today, not quite buying it. That conversation and so much more coming up in a bit. This is Bloomberg. All right, welcome back to The Close. It's time now to get the latest on what's going on in Israel. We do know that the death toll from the war with Hamas is still rising, approaching 2,000 people. And the United Nations says 180,000 more have been displaced in Gaza. Earlier on Bloomberg, we did hear from U.S. National Security Council spokesman John Kirby. He was asked about the U.S. and its approach to sanctions against Iran and questions growing about its involvement in the attacks. Take a listen.
We have not lightened any of the sanctions. In fact, we've added additional sanctions, some 400 sanctions on Iran just since the beginning of this administration. And we're absolutely committed to full and total enforcement. Now, obviously, other nations have to enforce their sanctions as well. And certainly we talk with them about that. But the United States has not backed off on any sanctions. Quite the contrary, we've added and increased our enforcement capability.
And that's John Kirby there speaking there outside the White House. And we are expected to hear from the President of the United States momentarily. Pleased to say, though, joining us right now is Peter Berkowitz, former director of the policy planning staff at the U.S. State Department. Peter, will you have to start off here and talk a little bit about not just so much what led to these events here, but also what the response will be. We're waiting to hear from the President of the United States. We know there will obviously be some sort of recommitment of military aid and financial aid as well. Is there anything more, though, that the U.S. and Israeli allies can do?
Well, it's good to be with you. And yes, there's more that the United States and allies can do. Actually, a carrier group is already has arrived in the Eastern Mediterranean, which brings immense military capabilities with it. Munitions and other military equipment has already begun to arrive in Israel from the United States. This is all very important. I hope the president, in the remarks he's about to deliver, emphatically explains that every action that Hamas has taken in the war that it launched, in the surprise attack that it launched on October 7th, is in itself a war crime, because all of its hostilities, its murdering, its raping, its kidnapping, all of this has been directed at civilians. And if there's one principle in the laws of war that's fundamental, it's that you don't attack civilians. So we should also remember that 11 Americans have been killed. Mm-hmm. We don't know exactly how many Americans are being held hostage. Yeah. I think it's very important for the United States to deliver the message that a great and decent power does not allow its civilians to be indiscriminately killed and kidnapped.
I am curious as to sort of how they go about this. I mean, we know the power of the U.S. military, and for that matter, the Israeli military as well. But as I'm sure you know, Peter, in order to sort of accomplish, I think, a lot of what some of the rhetoric we've heard from Israeli officials, it does not seem like it can be a strategic type of military assault. This seems like it has to be something broader. And I'm wondering how these nations are going to be able to reconcile the potential casualties, civilian casualties, I should say, in that type of operation.
Well, you're quite right that this that the Israeli government understands this military conflict as quite different from the last 4 armed conflicts it's been involved in with Hamas. That takes us back to 2009, again in 2012, again in 2014, and again in 2021. Israel operated to silence Hamas rockets and missiles that were aimed at Israeli civilian populations. Prime Minister Netanyahu declared on the first day of hostilities on October 7th that this time is different, this time it's war, and that Israel's ambition is to utterly annihilate Hamas's military capabilities. As you've suggested, that means going into the Gaza Strip, hunting down Hamas operatives, Hamas commanders, disarming them, and destroying their capabilities to wreak havoc and commit war against Israel. That will be lengthy and ugly.
Well, what should the U.S.'s role here be outside of just Israel and Hamas when you consider Iran's role and the questions there? Of course, we heard from John Kirby saying that the U.S. is committed to sanctions, committed to enforcing sanctions. Do you think that that's forceful enough?
Well, it's hard to reconcile what Mr. Kirby said with the $6 billion that the United States released just a few weeks ago, along with five Iranian nationals that we justly held in order to secure the release of 5 Americans, and thank God they're free. But that's $6 million, although it's supposedly earmarked for food and medicine, is fungible money. That releases up $6 billion to fund terrorism around the region, as Iran has been doing for decades, and I mean terrorism, instability in Iraq, in Syria, in Lebanon, in Yemen, and certainly in the Gaza Strip. So I think it's very important for the United States for the president to make a clear statement about Iran's role in funding Hamas, and also for as the United States has already begun to do, support Israel's military action, again, not just with munitions and military equipment, with very clear explanations about both the essential criminality of the Hamas enterprise and Israel's permission under the international laws of war to take the steps that are necessary to disarm Hamas and dismantle its jihadist network.
All right, Peter, got to leave it there. Really appreciate your time today. Our thanks to Peter Berkowitz, former director of the policy planning staff at the U.S. State Department. And of course, we are awaiting President Biden's remarks on the Israel-Hamas war from the White House. We will bring that to you live. This is Bloomberg.
All right, our Bloomberg reporters have learned that China is considering raising its budget deficit for the year. The government preparing to unleash a new round of stimulus to help meet its official economic growth targets. Gerard DePippo joining us right now, senior geoeconomics analyst over at Bloomberg Economics. And Gerard, I was just taking a look at this. This is a lot of money, $1 trillion won, more than $100 billion US dollars worth here. But the key seems to be that this is going to come from the central federal government, if you will, for lack of a better term, rather than from the local government. How unusual is that?
It's fairly unusual. They did it in 2020, but what's being reported is that the central government is considering issuing bonds on its own balance sheet and then would transfer those revenues for infrastructure projects to local governments. Typically what happens is the central government transfers revenues generally as part of the normal budgetary process, and then they give bond quotas to localities to do their own infrastructure project. But this would be sort of direct central support.
And what is the logic behind doing this through the central government, issuing these bonds through that vehicle?
Basically, a lot of localities are tapped out. I mean, normally if localities are responsible for either issuing debt or raising money by selling land, the property market and therefore land market are very weak at the moment, and a lot of them just have too much debt. So basically either Beijing pays for it or it doesn't happen.
So when we get to this idea, I mean, let's assume that they actually do roll this out here. Do we have an understanding of just how much of a material impact it will have on the economic growth rate?
Sure. Well, Bloomberg Economics expected even before this that China would hit its 5% growth target for this year. We cumulative before this announcement, we would have said there were about 2 percentage points of support, mostly monetary policy, which we're saying is not a bazooka, but it's many pistols. This is getting closer to maybe a rifle. This would boost growth maybe by 0.2 percentage points this year, and then 0.5 percentage point next year, which is a pretty large boost, all considering.
Well, Gerard, they last did this in 2020, I believe. And does the 2020 experience of issuing that type of bond give us any blueprint for how this might go? Or is 2020 such a unique experience that it's hard to extrapolate?
Well, 2020 was COVID, right? So they only do it under special circumstances where the economy isn't normally functioning. And I think what it tells us is that the central government sees this as another special case. The central government likes to have an artificially low fiscal deficit, so they say it's about 3% of GDP. They actually don't count these types of special bonds towards a deficit, which is not exactly accurate accounting, but it's how they do it. But I think it does tell you something about what they're worried about.
Gerard DePippo over at Bloomberg Economics. There, we need to go to the White House and listen in to the President of the United States.
I mean this literally, when the pure, unadulterated evil is unleashed on this world. The people of Israel lived through one such moment this weekend. The bloody hands of the terrorist organization Hamas, a group whose stated purpose for being is to kill Jews. This was an act of sheer evil. More than 1,000 civilians slaughtered, not just killed, slaughtered in Israel. Among them, at least 14 American citizens killed. Parents butchered using their bodies to try to protect their children. Stomach-turning reports of babies being killed. Entire families slain. Young people massacred while attending a musical festival to celebrate peace. Women raped, assaulted, paraded as trophies. Families hid their fear for hours and hours, desperately trying to keep their children quiet to avoid drawing attention. And thousands of wounded, alive but carrying with them the bullet holes and the shrapnel wounds and the memory of what they endured. You all know these traumas never go away. There's still so many families desperately waiting to hear the fate of their loved ones, not knowing if they're alive or dead or hostages. Infants in their mother's arms, grandparents in wheelchairs, Holocaust survivors abducted and held hostage. Hostages whom Hamas has now threatened to execute in violation of every code of human morality. It's abhorrent. The brutality of Hamas, these bloodthirstiness brings to mind the worst rampages of ISIS. This is terrorism. But sadly, for the Jewish people, it's not new. This attack has brought to the surface painful memories and the scars left by a millennia of anti-Semitism and genocide of the Jewish people. So in this moment, we must be crystal clear. We stand with Israel. We stand with Israel. And we will make sure Israel has what it needs to take care of its citizens, defend itself, and respond to this attack. There's no justification for terrorism. There's no excuse. Hamas does not stand for the Palestinian people's right to dignity and self-determination. Its stated purpose is the annihilation of the State of Israel and the murder of Jewish people. They use Palestinian civilians as human shields. Hamas offers nothing but terror and bloodshed with no regard to who pays the price. The loss of innocent life is heartbreaking. Like every nation in the world, Israel has the right to respond, indeed has a duty to respond to these vicious attacks. I just got off the phone with a third call with Prime Minister Netanyahu, and I told him the United States experience what Israel is experiencing, our response would be swift, decisive, and overwhelming. We also discussed how democracies like Israel and the United States are stronger and more secure when we act according to the rule of law. Terrorists purposely target civilians, kill them. We uphold the laws of war, the law of war. It matters. There's a difference. Today, Americans across the country are praying for all those families that have been ripped apart. A lot of us know how it feels. It leaves a black hole in your chest when you lose family. Feeling like you're being sucked in. The anger, the pain, the sense of hopelessness. This is what they mean by a human tragedy, an atrocity on an appalling scale. But we're going to continue to stand united, supporting the people of Israel who are suffering unspeakable losses and opposing the hatred and violence of terrorism. My team has been in near constant communication with our Israeli partners and partners all across the region and the world from the moment this crisis began. We're surging additional military assistance, including ammunition and interceptors, to replenish Iron Dome. We're going to make sure that Israel does not run out of these critical assets to defend its cities and its citizens. My administration has consulted closely with Congress throughout this crisis. And when Congress returns, we're going to ask them to take urgent action to fund the national security requirements of our critical partners. This is not about party or politics. This is about the security of our world, the security of the United States of America. We now know that American citizens are among those being held by Hamas. I've directed my team to share intelligence and deploy additional experts from across the United States government to consult with and advise Israeli counterparts on hostage recovery efforts. Because as president, I have no higher priority than the safety of Americans being held hostage around the world. The United States has also enhanced our military force posture in the region to strengthen our deterrence. The Department of Defense has moved the USS Gerald R. Ford Carrier Strike Group to the Eastern Mediterranean and bolstered our fighter aircraft presence. And we stand ready to move in additional assets as needed. Let me say again, to any country, any organization, anyone thinking of taking advantage of this situation, I have one word: don't. Don't. Our hearts may be broken, but our resolve is clear. Yesterday, I also spoke with the leaders of France, Germany, Italy, and UK to discuss the latest developments with our European allies and coordinate our united response. This comes on top of days of steady engagement with partners across the region. We're also taking steps at home. In cities across the United States of America, police departments have stepped up security around centers of Jewish life. The Department of Homeland Security and the Federal Bureau of Investigation are working closely with state and local law enforcement and Jewish community partners to identify and disrupt any domestic threat that could emerge in connection with these horrific attacks. This is a moment for the United States to come together, to grieve with those who are mourning. Let's be real clear. There is no place for hate in America. Not against Jews, not against Muslims, not against anybody. We reject. What we reject is terrorism. We condemn the indiscriminate evil, just as we've always done. That's what America stands for. You know, just over 50 years ago, I was thinking about it this morning, talking to the Secretary of State, the Vice President in my office. Over 50 years ago, as a young senator, I visited Israel for the first time as a newly elected senator. And I had a long, long trip, a meeting with Golda Meir in her office just before the Yom Kippur War. And I guess she could see the consternation on my face as she described what was being faced. They were facing. We walked outside in that sort of hallway outside her office to have some photos. She looked at me all of a sudden and said, "Would you like to have a photograph?" And so I got up and followed her out. We were standing there silent, looking at the press. She could tell, I guess, I was concerned. She leaned over and whispered to me. She said, Don't worry, Senator Biden. We have a secret weapon here in Israel. My word is what she said. We have no place else to go. We have no place else to go. For 75 years, Israel has stood as the ultimate guarantor of the security of Jewish people around the world, so that the atrocities of the past could never happen again. And let there be no doubt, the United States has Israel's back. We will make sure the Jewish and democratic state of Israel can defend itself today, tomorrow, as we always have. It's as simple as that. These atrocities have been sickening. We're with Israel. Let's make no mistake. Thank you.
Mr. President, what was your reaction?
President Joe Biden walking out of the state dining room in the White House there, a brief speech here, started very poignantly here, talking about the events that unfolded over the weekend near Gaza, right outside of Gaza, calling it, "This is terrorism." He reiterated the U.S.'s commitment to supporting Israel, both from a military standpoint as well as emotionally. He also talked about how he just got off the phone with Prime Minister Benjamin Netanyahu and agreed to provide additional ammunition, interceptors, and other things they need to replenish some of their critical supplies to defend their nation. And of course, ending on a very poignant moment about his time in Congress and the meeting he had with Golda Meir and the reasons, of course, given as to why the state of Israel even exists. Anne-Marie Hortern is joining us right now from our Washington bureau. And Anne-Marie, from the outside of the White House there, Anne-Marie, give us a sense here. The president did mention how he does need to go back to Congress for some modicum of funding here. What exactly does he need to ask for?
Well, the president talked about the fact that they will be sending surging ammunition to replenish Israel's Iron Dome, and he talked about the strength of the force posture that now exists in the Middle East, especially with the warships now moving in the eastern part of the Mediterranean. We heard from the chairman of the Joint Chiefs of Staff as well today, talking about the fact that that is there to deter the likes of Iran. And you really heard that from the president today, once again, a warning sign to everyone in the world to not take advantage of this situation. He did say that when Congress is back in session, he will ask for probably more aid, so there'll be a supplemental package. Of course, you know, we need to talk about a little bit of politics that are involved in this moment right now. There's an impasse, of course, the House of Representatives that does not have a speaker. But interim House Speaker Patrick McHenry did speak about to Politico that potentially they could move packages on the floor that were of urgency. So that would be something like Israeli aid. And there is a lot of bipartisan support right now in the Capitol in Washington, D.C. for that aid, and also on the Senate side to get some of these confirmations of these ambassadors that are set to go to their prospective destinations, most notably Jack Lew, who would be the incoming ambassador to Israel. But just on a broader point, this was a moment for the president to really strike a tone about what he has seen, the images he's seeing. He called it unadulterated evil, what he is witnessing, and he wanted to make it unequivocally clear that the United States stands behind Israel and that they have every right to defend themselves.
And Anne-Marie, we also heard President Biden confirm that American citizens are among those being held by Hamas. And of course, we heard Joe Biden reiterate, as you say, multiple times that the U.S. stands behind Israel. But how does the fact that American citizens are among the hostages factor into the U.S. response here?
Yeah, the president said this was likely yesterday, and in this speech, he confirmed it. Americans are in Gaza being held by Hamas. He also said that now we know that the death toll of Americans over this weekend massacre by Hamas into Israeli territory, that number now stands at 14. It was at 11. So this is weighing on the president. You know, everyone calls him an individual who a lot of times can be this counselor in chief, and he's he's doing that right now. Consoling American families was the tone I got from this president. When it comes to those hostages that are being held, what we do know is the president talked about this yesterday in the statement when he was likely certain that Americans would be among those numbered that were taken hostage. He said that he's directing his team to work with their counterparts in Israel to try to track them down. And as well as the FBI put out a statement yesterday saying this is of utmost importance. This is top of the agenda for them, and they are working with their counterparts on the ground. Of course, this is a very scary and precarious moment for these individuals, given the fact that it is all but likely that we are about to see a massive ground invasion by Israeli forces into Gaza.
Anne-Marie Horder there on the lawn of the White House here on the heels of the comments by the President of the United States reiterating the U.S. support for Israel. We're going to continue to follow this story and focus right now on the potential impact of this war being prolonged and the impact on global oil markets. They are facing heightened risk from the tumult going on over there in the Middle East. We want to get some insights now out of Kathy Kriskey, Commodities and Alternatives ETF Strategist over at Invesco. And Kathy, I am curious about the potential reaction in the commodity space should this turn out to be a much longer, more protracted war rather than something swift and definitive like the President of the United States seems to want. So far, other than the knee-jerk reaction we saw yesterday in crude markets here, there doesn't really seem to be a whole lot of concern just yet.
Exactly, and thanks for having me on. But obviously, what's going on is extremely tragic. And this situation remains fluid. So I think that to give this context in terms of oil prices, I think we do need to go back a few days, right? So in the past 10 days, we've seen major moves in oil prices. So as I said, as recently as 10 days ago, we were hitting highs in the 90s for WTI, right? And that was due to the Saudi OPEC cuts. A lot of, we weren't seeing very much demand destruction. Mm-hmm. So again, high prices. But then when we had that negative macro news, prices collapsed. Right. So believe it or not, in that 10-day period, we saw a range of $13.50 in prices. So we were in a low. So obviously over the weekend, the tragic events happened and we opened Sunday night higher. Right. And we were higher yesterday. But right now, the market's sort of frozen. I don't know if people have been watching it today. I'm looking at my screen right now, just, $86 for WTI. So we're waiting. We're waiting to see. Obviously, the president's speech, very impactful. But we have to wait and see, what happens. How does this move forward? Right? What are the factors that are going to happen with all of these countries in the Middle East?
I am curious if you could maybe draw some parallels in the market reaction to the war in Ukraine and when that invasion happened in late February, early March of 2022 here. You saw a very, very pronounced reaction in oil markets. We went from $90 a barrel roughly or so all the way up to, I think, 130 at one point in just a matter of a few days here. Why don't you think we're going to see that same type of reaction with regards to this particular war?
Okay, again, some geopolitics are often fall into that category of the unknown unknowns, right? And so we have to try and factor in what's on the sidelines, right? And that's why a lot of people believe like the best hedge against these surprises is commodities, right? So, but in the background, we know there's a lot of spare capacity, right? Saudi's big cut, UAE, like they have spare capacity. So that's in the background. Also, there are announcements that Venezuela is going to bring back some more barrels, right? And that Biden is going to allow that and lessening the sanctions, right? So I think there's a lot going on. That's why we're in the wait and see mode. But if some things happen that could happen, we could go substantially higher. And that's why, we look from the investor perspective, right? How do investors handle this? And one of the ways to deal with this is diversification within commodities, right? And that's why we say, don't just choose oil, right? Don't just choose gold. And we look at Ukraine and the mistakes investors made then, right? So I know, Romaine, you were mentioning how crude oil, skyrocketed, but also wheat, right? So remember the Ukraine, the breadbasket of Europe, people were concerned about there wouldn't be enough food, right? We're going to have starvation globally. And so what happened was, it traded up 6 days, limit up. But then, Russia started exporting massive amount of wheat. We saw, and it wasn't a big problem. So investors that chose to invest in that one commodity really got hurt, right? Mm-hmm. And then what did the U.S. do when we had the massive high prices? We had a serious SPR release, 1 million barrels per day, right? That lowered prices. So again, there's factors that are going into this. And that's why we say from an investment perspective, diversification, right? So we have these two broad-based commodity ETFs, PDBC and DBC, but we have energy, we have metals, we have agriculture, right? And so, and just recently in the past month, we've seen inflows of $450 million into our two main funds. So it shows that investors get it. This was before the invasion, the attack on over the weekend. The investments came in before that. So as we say to investors, right, generally commodity investors, people look at putting in 5% into their portfolio into commodities, right? But it's being cautious, right? And being ready. If you have 5% in your portfolio, then you're less susceptible to these shocks, these unknown unknowns, these surprises.
All right, Kathy, unfortunately, we got to leave it there. It's really great to catch up with you, though. Kathy Kriskey, Invesco Commodities and Alternatives ETF Strategist. This is The Close on Bloomberg.
All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with Qorvo, the maker of radio frequency chips, cut to sell over at Citi, increasing competition from the Chinese companies. That's the concern here, with the analysts saying Huawei actually surprised the market by actually launching that new phone with domestically made chips here, a potential replacement concern here for investor shares of Qorvo, down about 1% on the day. Next up, let's take a look at Rivian, upgraded to buy over at UBS. The analysts there seeing a better setup for the EV maker following that surprise $1.5 billion convertible debt offering that it announced last week. But the analyst says, look, no more capital is going to be needed until at least the end of 2025, which means the market right now can actually focus on the company's improving fundamentals. Those shares improving on the day by 5%. And finally, Electronic Arts, getting an upgrade today to buy over at Bank of America. They took a look at early numbers from the launch of that EA Sports FC 24 game. They're actually saying it's pretty decent here and should dispel some investor skepticism here about EA's growth story going forward. Those shares higher on the day by about 3%. And those are some of our top calls. We do want to say in the media and entertainment space, and take a look at Disney, which has some serious doubters right now, given all of the struggles with ESPN streaming, the writers and actors strikes, and the decline of linear television. But that's not stopping our next guest over at Bernstien from believing in that growth story. Joining us right now is Laurent Yoon, Bernstien senior analyst. He rates the stock and outperform. And Laurent, let's start off here with the bull case for Disney at a time where everybody seems to be looking at Bob Iger and saying he's just not getting it done. What do you see?
Yeah, maybe it's not such a difficult call to make since it's trading at the 52-week low and probably the lowest point over the past part of the decade. I think it's set up quite well for growth, especially the near term and the foreseeable future. And we see kind of three things that are happening. And maybe one thing just to get off the table is, yes, there's some bumpy road ahead given the secular decline of linear and traditional pay TV decline, but obviously that's not unique to Disney. It is a secular challenge the whole industry is expecting, and we all know that. Let's get off the table. There are three other things that I like to talk about. One is the near-term overhang that we have on Hulu, and then basically the question is, how much will Disney end up paying for that 33% of Hulu that Comcast still owns? And obviously that negotiation has started. And I think when that overhang is lifted, that will be a positive catalyst for the stock in the near term. And obviously, and the point that we're making here is that Disney is probably unlikely to overpay for that remaining 33%. That's probably a near-term catalyst to think about. And of course, the longer-term story here is, combined with Hulu when that deal's over, what does the prospect look like for the combined asset? In a nutshell, we believe the experience for the combined asset is going to be a lot better, which in turn tends to drive more engagement with more content and that better experience, which in turn drives more subscribers, not so much in the US because we're probably hitting towards the top subscription number, but also we look at opportunities outside the US, and we're quite favorable on what that looks like for the international market. And lastly, the parks business, we like to say it's the tree that keeps on giving and continues to perform. And people talk about, hey, maybe there's some pent-up demand that's been alleviated after COVID. Yes, the U.S. numbers are maybe looking a little bit soft in the near term, but globally, the international markets is picking up and supporting overall growth.
All right, Laurent, this is great stuff. We got to get you on when we have a little bit more time. We're going to have to leave it there. Laurent Yoon over at Bernstien, a closer look here at Disney, and a great read right now on the Bloomberg terminal about some of the challenges that Bob Iger has faced since his return. Stick with us. A lot more coverage coming up here on The Big Show. This is Bloomberg.
Well, the star witness in the trial of FTX co-founder Sam Bankman-Fried took the stand today in his fraud trial. Caroline Ellison testified that Bankman-Fried directed her to commit crimes. Bloomberg's Sheila Bassick is outside the New York courthouse. She joins us live. And Sheila, give us some of the highlights. What were some of the big takeaways from Caroline Ellison's testimony?
Well, it's just getting started. We are 2 hours, just about, give or take, into the testimony. There was a break in between. And you really have her starting to outline the way that Sam Bankman-Fried operated, the way he created the FTT token, and the way that he tried to control the price around the token. They're talking about Sam coins, other tokens that Sam was involved in as well as his personal ambitions. Remember, the reason Caroline Ellison's testimony is so important is threefold. One, she's an important part of the prosecution's own case, as well as brought up by the defense and its opening arguments. And lastly, she was his former girlfriend. She knows him very, very personally. And this was only her second job ever, working first at Jane Street and then at Alameda, the hedge fund that is in question that has allegedly siphoned money out of FTX to the tune of hundreds of millions of dollars and then used allegedly for Sam Bankman-Fried's own gain.
I am curious. I mean, given the testimony from her and the testimony from the other day, I mean, these people obviously know what happened. But at the end of the day, is there actual hard evidence being presented, or is this just the word of Caroline Ellison versus SBF's word, et cetera?
No, there's certainly evidence being presented here, Romaine. It's a good question because in the course of this testimony, and as I said, it's early still in Caroline's testimony, there's expected to be things along the lines of her personal diaries being shown, as well as a recording from November where she addressed the staff of Alameda at a very critical time. This was the time where you had that dispute online between Binance's CEO as well as Sam Bankman-Fried, and Sam trying to tell the world at that time, if you don't remember, that everything was fine. His co-founder earlier today had said that everything was not fine, and they knew that back in November. There's signal messages. There's a whole host of evidence being brought forth, but the prosecution has asked the jury to take that evidence in coordination with what they're hearing from his closest friends today.
All right, a lot going on down there in Lower Manhattan. Sheila Bassick outside the courthouse here where the Sam Bankman-Fried trial continues here for yet another day. Key testimony today from his former girlfriend as well as the woman who helped to lead one of the key ventures there alongside FTX. All right, we're rounding out into the final hour of trading here on this Tuesday afternoon. Stock market open for a second day, higher for a second day. The bond market reopening, and well, you're seeing a pretty big buy in here, 14, 15 basis points higher on a 10-year yield. This is Bloomberg. Lower. Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Let's get a view from the top here on this Tuesday afternoon. Modest gains for the S&P, the Dow, and the NASDAQ. But the Russell is actually the outperformer today. And I wonder, is this sort of the reawakening of the cyclical trade?
Is it? I don't know. It feels like we were just getting really used to saying how beaten up those small caps were. We're just getting really used to that yields rise every day narrative. And now maybe we're seeing a bit of a
tomorrow
flip-flop.
the narrative will change.
Yeah, we'll see. We'll see. I know one of the narratives we were getting used to was that the rise in yields was doing the Fed's work for them. But then you take a look at the big rally we're seeing across the curve. I don't know. Maybe that's cut short.
Yeah, and we should point out yields are down, Katie Greifeld.
They are, for sure.
As buying ensues, you look at the belly of the curve at 4.6 right now. WTI pulling back just a little bit on the day, and there was a pretty strong rally that we saw over in Asia. I mean, the Japanese stocks were up about 2% across the board. But flip up the board real quick here because I want to talk a little bit more about treasuries and that correlation between treasuries and the stock market, a correlation that has now turned positive. You're looking at the correlation between TLT, so the price side of the treasury trade, and of course with equities here. And I guess that's a good thing if everything's going up. But the problem, of course, is in the old days, Katie Greifeld, back when I was, trudging through 10 feet of snow to go to school, there was a negative correlation, so if stocks weren't doing well, you at least made money off bonds. If bonds weren't doing well, you made money off stocks. Now it's kind of an all or nothing kind of bet.
Yeah, and that, of course, is upending the calculus on things like the 60-40 portfolio, risk parity strategies, of course. It should be said that on a total return basis, if you hold the bonds to maturity, you're still going to make money. But in the short term,
don't ruin my narrative. Total return.
I know. On a total return basis, if you just wait it out, you'll be okay. But in the meantime, of course, you have absolutely no cushion. Let's talk about some individual movers. Let's talk about Truist specifically. Semaphore reported that it's looking to sell the rest of its insurance business to private equity firm Stone Point Capital for roughly $10 billion. Remember, they sold 20% stake to Stone Point earlier in the year, having a huge day. Of course, this is part of its efforts to shore up its balance sheet. You can see shares up 6.7%. I also want to talk about Rivian. This is an interesting flip-flop because yesterday it got a target cut from Wedbush, but today it was upgraded by UBS. This all comes back to that recent capital raise. I don't know how to feel about it.
I don't
honestly.
know. I guess it's the idea that they won't have to raise more capital for a while.
Yeah, I mean,
that seems to be the logic.
That's the UBS view, but then, of course, you had Wedbush say yesterday that the debt offering was a gut punch to investors. So I don't know how to feel, but Rivian shares, they're higher today. And I wanted to talk really quick about Acaro. I hope I'm saying that right.
Okay.
Acaro, of course, that is plunging by a record today after its liver disease had a mid-stage study. It was disappointing. And you can see that the share is down 60%.
Wow, yeah, a big drop here on the day here. A lot of other interesting moves going on out there as we move less than 1 hour away from those closing bells. Our cross-platform coverage, counting you down to the close, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues, Carol the Queen Masser and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and YouTube. Carol Masser, how are you?
I'm doing
Your
well.
Majesty.
I'm doing well. Thank you. Thank you, sire. Having said that, consumers and at least their household balance sheets seem to be doing just fine. Consumers, we know we talk about this, right, guys, all the time, how important consumer spending is to the U.S. economy specifically. We've talked a lot about the paring back of the balance sheets, household balance sheets, especially those at the lower income strata, if you will. Having said that, maybe that's not the case because based on some government data, when it comes to household savings, Tim, maybe things aren't so bleak.
Wait a second. I thought just a few weeks ago we got this report that said all this excess savings.
Be careful, Tim.
Whoa.
Very.
Bloomberg after dark all of a sudden.
Safe for work. Excess savings. I thought all that dried up. I don't know what's going on here.
I was confused by this,
look at the revised data.
I guess that's the point of being data-driven, Katie Greifeld. You can just cherry-pick whatever data you want.
No. Well, to be fair, government data that's saying that there's more money in household savings, right? And so now economists are going back and saying, well, wait a minute, maybe household balance sheets aren't so bad.
I do want to say it's not.
But where is the money?
I want to say it's not all good news. Where is the money? Is a good question. It's with the wealthiest Americans.
No, but I mean, like, they keep saying there's more money than we thought. But where is that extra cash stashed away?
It's under the mattress.
If you're a fan of Arrested Development, it's in the banana stand.
In the banana stand. Well, when we think about all these conflicting data sets that we're getting on excess savings, Tim, that's how you pronounce it.
Thank you.
I figure it'll show up in the official inflation data sooner or later, which brings me to the International Monetary Fund. This was interesting. They put out their projection for CPI across the world for the next year. They've actually boosted their projection to 5.8%. That is up from 5.2% from 3 months ago. And basically, it's calling central banks to remain vigilant on inflation risks, which kind of goes against what at least we're seeing in pricing for the Fed, with bond markets pretty much saying that the Fed is done.
Yeah, this was kind of fascinating. I mean, I guess, the IMF always puts out these forecasts ahead of these meetings here. And I guess if you do believe here that we are going to stay above that longer term trend here, then yeah, it makes the case that central banks need to stay put. But I mean, the elephant in the room is that a lot of central banks have already flipped the script. So it's a little confusing as to why they would make that statement that they should hold fast.
Yeah, I don't know. How's that for something intelligent? Not really. No, I just think I'm also just kind of waiting for all of the global central bank policy to really kick in. We keep talking about lag effect and so on and so forth here in the United States specifically, and that we're kind of seeing it, or we've seen the impact on some sectors already. I don't know. I guess it all just depends on whether or not we have a more significant slowdown. But watch those spending patterns, whether it was Golden Week in China or whether we look at the inflation data here in the U.S. and spending data, we'll get an idea of whether or not inflation is more stickier global-wide.
Yeah, I mean, it's a good reminder, too, that inflation's not just an issue here in the U.S. This is an issue, Romaine, that the entire world, the developed world, has certainly been dealing with over the past couple of years in the wake of all the government spending during the pandemic. So look, I mean, higher for longer is what we hear from the Fed. Higher for longer is what we hear from, the IMF also.
Yeah, absolutely. And look, I mean, we go back to sort of Katie talking about the CPI and PPI reports that we get over the next 36, 48 hours here. And I think we're going to see a ratification that, yeah, we're nowhere near that 2% target, no matter what you're looking at, whether it's core, super core, or, I don't know.
Super duper core?
I don't know.
That's a new one.
Special core?
So it's just more of the same.
Tim's got a lot of jokes today.
Yeah.
Excess savings.
Yeah.
I'll practice that one. Get back to you guys later in the program.
He got a really good night's sleep from what I hear.
Finally.
That's what's going on.
Okay.
All right. We're going to be back in less than an hour's time. We're going to count you down to the close on this Tuesday, radio, TV, YouTube, and Bloomberg Originals. We do it all. Join us, though, at 4 p.m. Wall Street time for Beyond the Bell.
All right, we continue our coverage right here on the close. Counting you down to those bells, just a little more than 50 minutes until we get there. Some interesting commentary out of a senior official over at the New York Fed saying that all is going well with the Fed's balance sheet runoff. Roberto Perle saying he's the manager of the System Open Market account who oversees the Fed's portfolio. He had this to say. He said, recently, our implementation framework has confronted a number of stress tests and performed quite well. This is all encouraging, but we remain cognizant of the risk and uncertainties ahead. Let's get some insights out of Karissa McDonough, Senior VP and Fixed Income Strategist at Nottingham Trust. It's a division of Community Bank, joining us right now to help us count down to the close. And Karissa, I do want to start here with those comments that we heard from Perle. And I guess it kind of makes sense. I mean, I guess when you look at the drawdown on the balance sheet, which hasn't been massive, to be sure, but there was a lot of concerns here that if the Fed really did sort of yank the rug out, that we would see some sort of collapse in the market, at least right now. I know there's some activity in the repos space right now, but nowhere near sort of the critical concerns that we had a couple of years ago.
Hi, thanks so much for having me. Yes, I think that that's absolutely correct. We think that the Fed has been really careful in terms of, like Roberto said, the stress tests. And while we have seen long rates really move up quite precipitously, with the exception of the last couple of trading days, I think that's kind of a testament to how carefully the Fed is managing that bond roll-off. So we're in agreement with that sentiment to a large extent.
There's obviously a lot of talk here about what's going on the short end of the curve and what the Fed controls. But I want to get your thoughts, Karissa, about some of the activity that we've seen on the long end of the curve over the past few weeks. I mean, let's take today and yesterday out of the equation, because we know there have been other events that have sort of moved treasuries around. But when you look at that relentless sell-off that we saw on the 10-year and the 30-year yield prior to this week here, what do you think investors were basically saying? What were they communicating?
Well, there were pretty much two primary reasons why we had such a significant sell-off. I mean, one of it, obviously, we saw that blowout jobs report pretty much double what expectations were. So again, bond investors thought, well, the Fed is going to go ahead and have to hike again, possibly at the November meeting, possibly December. But the other part is the concern, just, the U.S. budget deficit continues to be just so large, and there continues to be persistent need by the Treasury to fund. So the whole notion that the Treasury has all this funding to do, I think that just the outsized level of debt, that is actually what's driving yields higher. It was the inflation discussion, but if you look at break-evens, those break-evens have been relatively stable. It's been real rates that have been moving up. So that's, yes, there's concern by bond investors about the absolute level of debt kind of out there.
And are we past the bulk of that repricing, that digestion of just how high those debt levels are? Or do you think that there's still some room to go here?
We believe that there's still a little bit of room to go. Now, Romaine said at the beginning that there have been kind of other events with Israel, et cetera, the last couple of days. But I think once the markets kind of get its footing back under them again, we're going to continue to see kind of a march upwards and longer yields. Again, the issue is, if real yields are higher than kind of the sustainable level of GDP, that just means the bond market thinks that this is not kind of a sustainable level of debt, and something is going to happen to kind of curb that movement.
And Karissa, all that being said, I talked to a lot of bond investors who are extremely bullish on duration right now, saying basically it's time to go out the curve, lock in those very high rates, those decade high yields that we're seeing. Are you on that bandwagon as well?
Yes, well, the risk reward for duration is extraordinarily favorable right now, and it's just the bond math. If you have just a slight decrease in yields from here for the 10-year, we can talk about a double-digit total return in long bonds, and we haven't seen that in literally years. Even the 2-year, if you have a 1% drop in rates, you could have something like a 6% return. But duration, even if we have a little bit of move upwards from here, we're nearer to the ceiling at this point. So we're extremely bullish as well.
And Karissa, just to tie a bow on that thought, when you think about those double-digit returns, the possibility for double-digit returns and the asymmetric risks right now, how unusual is this moment to get that degree of asymmetry?
That's an excellent question. This is very rare, and I don't think, my colleagues, et cetera, are not used to me like pounding the table on treasuries. You don't have to go to high yield. You don't even have to look at corporates. This is an opportunity that, the rates on treasuries are affording us right now. This usually happens when you're talking about an inverted curve and you're ahead of some sort of possible financial issue or recession, but this is the time to kind of lock in those types of rates. So yes, it's relatively rare, but it's such an opportunity.
All right, Karissa, great to check in with you. Really appreciate your time. That is Karissa McDonough of Nottingham Trust. Now, coming up, we're going to keep the conversation in the bond market and take a closer look at the factors that explain what's behind the recent rise in long-term Treasury yields.
Plus, a little more insight here into Israel's war with Hamas and what could happen next. Dennis Ross, who served as the special Middle East coordinator under President Bill Clinton, has a lifetime of service here in the diplomatic corps, is going to be joining us later.
And we'll discuss defense stocks with Sheila, Kahyaoglu, analyst over at Jefferies. All that and more coming up. This is Bloomberg.
About 44 minutes until we get to the closing bells here on this Tuesday afternoon, the third day of gains for the S&P, the NASDAQ, as well as the Dow, the Russell 2000. That's your outperformer on the day and headed for what looks like it's going to be a fifth straight day of gains. The U.S. bond market has reopened coming off the holiday, and that big buying that we saw yesterday in some of the ETFs and other funds that track the bond market, that's reflected today in the big drop that we're seeing in yields, down about 14, 15 basis points across the board here, with the entire curve now shifting just a little bit lower. Some of that has to do with the fears coming out of the Israel-Hamas war. Some of that, of course, has to do with, I guess, somewhat dovish talk that we've been hearing out of various Fed members, including Romaine Bostick, Philip Jefferson, Mary Daly, and others as well. The Bloomberg Dollar Spot Index not really going anywhere here on the day, but you are seeing a lot of activity in the commodities space. The big drop that we saw earlier in the day in base metals, some concerns here about the second largest economy over there in China and its appetite for those metals. Let's bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail, you've been taking a closer look at some of the big moves in yields and what it means for stock volatility.
Well, it's certainly a topic du jour and of the year, of course, because as yields go higher, it tends to increase volatility for stocks. To talk more about this, let's bring in Matt Rowe of Nomura, head of cross-asset strategies there. Great to have you with us, as always, Matt. And so yesterday, of course, the bond market was closed for the holiday. Today it's open, and we have a pretty decent rally for bonds. And there seemed to be, the main narrative that I'm hearing is that it has to do more with the Fed as opposed to a flight to safety around geopolitical tensions. It's hard for me to believe that it's not a lot of the latter and that it's the Fed. What are your thoughts, and what are you hearing from your clients and on the desk?
Well, I think you're right. I think it's a combination of the two. And there was some commentary over the weekend, including the holiday, that higher for longer in a static state by itself has some deterrence effect. So there was some communication to the market that we don't necessarily need to keep raising rates for this policy to cool things down a bit. And I think that that's a really important message, because as somebody who looks across assets for a living, really the big story to me is that capital structures are not universally sustainable with a cost of capital north of 10%. So there's a lot of pain both on the consumer side with mortgages, which are easy to understand and observe, but also on the corporate side too. A lot of companies can't really run the same business.
Yeah, that messaging seems to come up quite a bit, that if rates go too high, that even the U.S. at some point they may not be able to pay the interest. A whole other conversation. Yeah. But when we bring rising rates into the conversation of volatility, right now we have the VIX going back lower, and then we also think about the reliance of investors on the idea that the Fed's not going anywhere.
Yeah.
Is the Fed put somehow reemerging in this conversation?
Yeah, that's a really interesting and timely question, because we just passed the 25th anniversary of long-term capital, and there were a couple of articles that were talking about long-term capital being the beginning of the notion of the Fed put, when policy steps in to sort of put a net under the market or to soften a risk-off move. I think that the big issue here, and it relates to cost of capital, for companies, for people, but where public markets are concerned, more so for companies. If you take, the base rate up to 5, 6, 7%, as Jamie Dimon alluded as being potentially possible, that takes corporate funding to rates that, again, aren't sustainable. So you're going to start to see failures. When you start to see failures, then you think about the distribution of stock returns. You're going to have some stocks that don't just outperform or underperform, but you're going to have what's referred to as the third node effect, which means in the distribution tree, it could go up, it could go down, or they could fail. The notion of failure has been outside the vocabulary of the market largely for the last couple of decades.
Although it's failure in terms of bankruptcies, are you talking about?
Yeah.
Well, it's interesting because I was just reading that this year there have been the most amount of bankruptcies that there have been in quite some time, and we can think of a few big ones such as Bed Bath & Beyond, but the idea that more of that could be happening. So if we tie this back into volatility, right now, technically, chart-wise, it appears as though stocks may go a little bit higher. It looks like the VIX may hang out at current levels, but I would say that in a couple of weeks, it appears that we're probably going to go back to the selling that we saw. And that's just my observations, frankly, on the charts. What are your views and how do you play volatility given all of the uncertainty?
Yeah. So I oftentimes refer to implied volatility as implied distribution. So when it's low, it means a very narrow range of outcomes. When it's high, it means a wide range of outcomes, more uncertainty. I think we are, for many reasons, whether you look at financial metrics or you look at geopolitical metrics, there's a lot of uncertainty. And I said a couple of weeks ago, the market looked priced for perfection in an imperfect world. I still think that that's the case. And I think that what we're seeing is we're seeing a little bit of a risk transfer. We're seeing the Fed trying to wean investors off of the reliance on the Fed put, or at least recalibrating the strike of the Fed put. Right? Yes. It's not that there won't be accommodative policy available in reaction to certain anomalous market events, but I don't think that the market should be relying on such a high strike Fed put.
Yeah, I think that that's a great observation, especially given the fact that the Fed has stayed with the hiking path, and also Jerome Powell has even straight out said that we're not going to be cutting for years. FYI, that put those training wheels might not be there. In about 30 seconds, 30, 40 seconds, I know that Amy Wu Silverman is out with talking about why one reason that the VIX really has not gone so much higher yet, despite all of the uncertainty. Can you talk to us just a little bit about that?
Yeah, it was a very timely article on something that's near and dear to my heart, so thank you to her for writing this piece. But there has been this observable momentum in commercial product development, I guess you could say, in financial product, of volatility selling strategies. All forms of long risk are short volatility trades. It's just a matter of understanding, what strikes you're short and what strikes you're long. Which is to say, if you're long stock, you lose money if there's a big risk off, and corporate bonds are the same. So the commercial momentum of selling volatility to generate yield ran right through the rate hiking cycle. So even while base rates have come up dramatically in a historical fashion, there's still this appetite for yield. And the last I looked, the aggregate of the top of that market was about $60 billion in assets and going up quickly. So while we're seeing markets reprice, we have a huge supply of vol for sale. So For people like me, we're building strategies to take advantage of that, to get long volatility on the heels of that.
Very interesting. Great observations as always. Matt Rowe of Nomura, thank you so much for joining us for Options Insight today. And from New York, this is Bloomberg.
All right, reports of the demise of excess U.S. household saving, Katie Greifeld. I think that's your line.
That is my line. Reports of the demise, like you said, excess household savings. We were just talking about how they've all been depleted. That was according to data from the Federal Reserve a few weeks ago. But now we have revised government data out that indicates that actually Americans, they have hundreds of billions of dollars more in extra cash than previous believed. So weigh it all together, Romaine, I'm not really sure to think. But apparently, you know, Americans still are sitting on some of those savings that they accumulated during the pandemic.
Oh, do I speak now? Oh, okay, sorry. Yeah, that's a good point, Katie Greifeld. I'm actually very confused by this.
Yeah,
because this seems to be more of a timing issue. And I mean, obviously, these are economists who are way wonkier than us here. But this seems to be more of an issue of whether you believe prior to the pandemic there was a certain amount there, or whether that wasn't an amount there.
Yeah.
But this is money we're talking about, right? Like, it's not.
We should be able to find it.
It's fungible, as like
unless
the kids
they
call.
took it out of the bank and put it under their mattress.
Okay.
I'll echo what I said in the simulcast. Yeah. I mean, this is going to show up eventually in the official data that we get when it comes to consumer spending.
Can we trust that official data, Katie Greifeld? Because I just read a story today saying that I shouldn't.
I don't know. You know, you have to have something to rely on, and I rely on the official data. But we'll continue to cover it, even if Romaine doesn't. This is Bloomberg.
Welcome back to The Close. It's time now for our Wall Street Week daily segment. And today we are taking a look at the war in Israel. The Israeli death toll from that war with Hamas has now surpassed 1,000 as the conflict enters its fourth day. Our next guest has been at the forefront of peace negotiations over the last few decades as an ambassador in various roles here in the U.S. I'm pleased to say that Dennis Ross joins us right now. He's now at the Washington Institute for Near East Policy, a counselor and distinguished fellow there. And Ambassador Ross, I want to start off kind of with the context of kind of where we were, I don't know, just a couple weeks ago. I mean, we were talking on this program about Saudi Arabia and Israel potentially normalizing relations, something that I have to admit I didn't think I would see in my lifetime. And it seemed very real. It seemed very tangible. Yeah. And I'm wondering if the developments over the last few days is going to disrupt that in a meaningful and potentially definitive way.
Look, it's a very important question because I think one of the triggers for Hamas's action was precisely to ensure that that breakthrough did not take place. For Hamas and for Iran, such a breakthrough changes the landscape of the Middle East fundamentally. It very much takes the religious element of the Arab-Israeli conflict largely, maybe not totally, but largely out of the equation. It promises a network of states that are committed to making their societies resilient and able to advance in the 21st century, all of which stands in a very sharp contrast to Iran, Hezbollah, Hamas, and the kind of failed possibilities for the future that they offer. So this was kind of a reflection of a desire to disrupt it. People tend to ignore that the Supreme Leader of Iran last week gave a speech in which he railed against the possibility of normalization, talked about threats to those who would do it, and then we see Hamas go ahead and carry this out. Now, that doesn't mean this was totally orchestrated by Iran. They certainly supported something like this. It doesn't mean that Iran knew exactly when this was going to take place, and it doesn't mean that this didn't take a long time to prepare. It did.
Right.
But the aim was clearly designed to sort of frustrate the very breakthrough that you were talking about. My own sense is that we'll have to see how this comes out and whether Hamas is seen as having been defeated as opposed to having come out of this with some sense of a victory.
Well, that's what I'm curious. I'm curious as to what that defeat actually looks like. Because as you know, I mean, you're not really dealing with a military in the traditional sense here when dealing with Hamas. And we know that there is a lot of commingling between the Hamas fighters and just the civilian population here. When you think back to some of the deals you were involved in, some of the things that did bring some semblance of stability, I do wonder if maybe one of the big errors, whether it's the Israelis or the U.S. and its allies made, was not confronting Hamas more directly 10, 15, 20 years ago.
I think the answer to that is yes. I think there was a perception, certainly on the Israeli side, that somehow they could manage the conflict with Hamas and they could live with it. That's what you saw them doing. You saw them, and you know, this has been the case largely, I would say, since 2009. Now, Hamas takes over in a coup from the Palestinian Authority and Fatah in 2007. And Israel withdrew from Gaza 100% in the fall of 2005. They did not impose a blockade or a quarantine on Gaza from the fall of 2005 until the coup by Hamas in 2007. Hamas never stopped attacking Israel even after it withdrew from Gaza. Now, you had repeated conflicts that were provoked by Hamas 2008-9, 2012, 2014, 2021. These were always concluded with a ceasefire, and Hamas used all those ceasefires to rebuild and get ready for the next round. So in a sense, the Israelis came to the conclusion they could manage this at a tolerable price, and I think they now have that conclusion, that assumption shattered. So your question is well put. Hamas is an actor that was never prepared to live with peace. When I was our lead negotiator, it was their bombings in Israel that helped to upend the very process we were trying to negotiate. So I think we should have looked at Hamas for what they are, which is an Islamist group, meaning it uses Islam as a political ideology for control and power. It certainly doesn't reflect the values of religion or the values of Islam. And it's an extremist group. It aims to use rejection and violence and terror. We're seeing its face fully exposed by the way it carried out this attack and the way it just went in, focused on killing civilians, and then did things that we would have thought were impossible. How does a group take women who are in their mid-80s in wheelchairs, babies who are 6 months and to 3 or 4 years old? How do they take them as hostages? But they did. And that tells us very much who Hamas is. There are no norms it's prepared to respect.
Well, Ambassador, in addition to Hamas, you also told Politico over the weekend that Israel here faces the prospect of a multi-front war. And if that's the case, if we do descend into that sort of situation, what would that mean for the Middle East at large?
Well, you're looking at a war that will expand not just horizontally, but probably vertically as well. I'm not sure it will expand beyond Hezbollah, although, if Israel is not really keen on expanding how many fronts it has to face, but if it's dealing with Hamas, and it's dealing with what could be 3,000 rockets a day from Hezbollah, I'm not sure that Israel says, gee, I think we'll just let Iran, having provoked all this or been behind all this and promoting it, that we'll let them sit on the sidelines and not pay a price. So there is a potential for this to expand throughout the region as a whole. It'll be very interesting to see what Hezbollah does. Hezbollah is signaling right now that it is prepared to strike Israel, but it's doing it in a very limited way.
Yeah.
And I've often thought that Iran looks at Hezbollah as a kind of reserve. And Iran right now may fear that it could be hit. And instead of, in a sense, having Hezbollah go all in at this point, it may want to use it as a kind of deterrent against Israel hitting Iran in the current setting. So while I think there's a real risk of a second front, while I think there's a real risk of escalation, maybe even by inadvertence or misreading, I also think at this point Hezbollah doesn't look like it's anxious to get into that. We'll see if that remains the case or not. It certainly changes the character of the war if they come in.
Yeah.
It makes it much bloodier, much longer. The cost will be much higher. It'll be terrible for everybody. It'll be a disaster within Gaza. It'll be a disaster within Lebanon, but the price will be high for Israel as well.
All right, going to have to leave it there. Dennis, really great to catch up with you and get your insights here. Ambassador Dennis Ross there now at the Washington Institute for Near East Policy. And tomorrow, we're going to be joined on Wall Street Week Daily by Harvard professor Ken Rogoff and get his insights as well on the global situation. And just a reminder, you can catch highlights from all of our conversations every Friday at 6 p.m. New York time on Wall Street Week with David Weston right here on Bloomberg. Coming up here on The Close, we're going to focus on PepsiCo boosting its profit forecast after reporting third quarter results that beat expectations. That's our stock of the hour, and it's coming up next. This is Bloomberg. This is the countdown to the close. Less than 30 minutes to go here in the trading day, Katie.
And the S&P 500 solidly in the green, 0.6%, but it is a broad-based rally. Take a look. You have every single sector in the green, 11 out of 11. Up top on that circle, you have utilities up by 1.2%. Materials, consumer discretionary, consumer staples, all more than 1% higher today. You take a look at the relative laggard. It's real estate, it's energy, up just 0.1%, Romaine.
Yeah, absolutely. And just take a look at some of the quick individual movers here. Remember, we had that big rally yesterday here, and some of the defense contractors here pulling back just a little bit. Northrop Grumman down about 1% or so here on the day. Of course, that's after the big rally yesterday where it rallied more than 11%. Hyatt Hotels at the top of your screen also having one of its best days going back to June of this year. And this largely seems to be tied, Katie Greifeld, to what we've been seeing with regards to its replacing national instruments in the S&P Mid-Cap 400 index. Amazon, another prime day. I don't know how many prime days they have now, but that's getting a bid here on the day as well, Katie. Let's just go.
Shall we? Let's also stay in the stock market and talk about PepsiCo. It's our stock of the hour after its third quarter results beat estimates. Earlier today, CFO Hugh Johnston weighed in with Bloomberg about the ongoing concerns in the snack community regarding weight loss drugs like Ozempic. Take a listen.
I think the adoption will likely be pretty slow on this. And the result is, as consumers sort of migrate their eating habits, we'll migrate with them. I don't think snacking is going away. To the degree they want to evolve their forms of snacking, I'm pretty sure we're going to be right there with them.
All right, let's talk more about the snack community with Brett Pulley. He is Bloomberg News Atlanta bureau chief. And Brett, honestly, when I saw this headline, when I saw these comments, it was kind of like a reality check because it feels like a lot of companies have been trotting out these weight loss drugs and saying that this is going to be a risk.
Well, yeah, people are saying it's going to be a risk, certainly in the food and beverage industry, which is what we're talking about with PepsiCo. It's advantageous to think right now that there are a lot of hurdles to clear, and I think that's one of the points that the CFO Johnston was making earlier today. It's almost like we have some time here. He talked about barriers to consumption. You know, he talked about the fact that it has to be tested, and we have to see what the side effects are, the fact that the drugs are currently administered through shots, and that would have to change. So there's this idea that there's time, but it seems like we've seen and heard this before, and it may not be as much time as we all think, given the fast growing popularity of these drugs.
Well, that's what I think is interesting, too. I mean, of course, we already had that commentary out of Walmart, and if you believe what some of the analysts and investors have said about the potential growth rate for these drugs in the market here, it seems like it's a lot sooner than later in terms of its actual impact, Brett.
No, you're right. I mean, the CFO at Pepsi today is saying we don't detect any signs in our numbers so far. And the chief executive officer as well, Ramon Laguarta, earlier today on a call with analysts, certainly acknowledged that this is something we're watching closely. But the feeling is we're prepared for it. We're prepared for whatever may come with people's eating habits. As Hugh Johnston said, as people migrate, we'll migrate with them. But I think the great unknown question here is what happens if people just start eating less as a result of these drugs.
Yeah, I mean, that would be wild, Brett. Of course, considering I think we've all been eating way too much, if you believe the scientists. Brett Pulley joining us today for a look here at PepsiCo. That is our stock of the hour here. A focus here on those weight loss drugs, Katie Greifeld, and the disruptions to the snack community.
The snack community. I am a card-carrying member of the snack community.
Are you really?
Yes.
I didn't know.
Yeah.
What is it? What is the
I can
membership?
get you
Is there
in.
a fee?
No, no monthly fee. Don't worry about it.
All right, we continue to count you down to the closing bells. Deborah Cunningham over at Federated Hermes going to be joining the big program in just a second. Green on the screen across the board for the major indices. Big moves in the Treasury space as well. This is the countdown to the close. Romaine Bostick here, joined now by Scarlet Fu, as she does every day at this time, to help us take us to the bell and beyond. The third day of gains here for the broader equity market here, Scarlet. But I think the real activity is a reopening of the bond market.
Yep.
And we're getting a nice preview here, I think, of how the market has interpreted some of these Fed comments.
Pretty dovish Fed speak that we've gotten the last couple of days, and today didn't hurt either. And of course, whether this I guess it's a little bit of a bounce back continues will depend in large part on the PPI and CPI numbers that we get later on this week. Right now, it definitely feels like bonds are playing catch up, given that the Treasury market was closed yesterday.
Yeah, definitely so. I mean, we saw that obviously play out in TLT, which was trading that ETF here, but now the actual bond investors get at it. But I thought it was interesting. I mean, Neil Kashkari was speaking. There's this Q&A for him, and he actually said that he was kind of perplexed by the recent moves that he said. He was
He's
talking
being
about
honest.
The upper moves that we saw in the 10-year yield prior to what we're seeing today. But I thought it was interesting. I don't know. That comment struck me as odd because I don't know. I know they're not complete geniuses over there at the Fed, but shouldn't he understand why yields have moved up so much over the last 4 to 5 weeks?
It's a good reminder that they too are kind of taken aback perhaps by the speed with which yields have moved up. I mean, there's a fundamental reason behind it, but then there's a lot of things that don't explain why it would move up by 14 basis points on any given day or down by that amount, which is what's happening today, certainly when you look at the 10-year.
Yeah, absolutely. He also kind of reiterates the idea that maybe the Fed can do less now that the market is doing all of its work for it. Let's get some insights out of Deborah Cunningham. She's a global liquidity market CIO over at Federated Hermes. Deborah, great to have you here on the program here. And obviously everybody's obsessing over the Fed and whatever they may or may not do next. I thought we were almost to the point where we can stop talking about the Fed as much as we've been talking about them. Was that premature?
Well, I kind of thought we were almost at that point, Romaine, as well. And I think a couple things have happened. I think the conflict with Israel and Palestine over the weekend has sent treasuries into a flight to quality bid that has erased, I think, what some of the sort of more dovish Fed speak had been alluding to over the weekend and then yesterday with the bond market closed. So to some degree, the gains that we're seeing in the bond market with yields, going down and prices going up, I think is very much a flight to quality type of trade and not necessarily reflective of the Fed. So I'm not sure, the Fed plays as much into this, current day's market movements as we might think. Having said that, I think what it does is take away some of sort of the reasoning behind the dovish Fed comments most recently that were based upon, well, the bond market has started to reconcile with higher for longer. And so maybe that's enough and we don't have to move anymore. I think maybe the bond market is going in the opposite direction now as we're seeing, and that may not be the same for the next set of Fed remarks we see.
Well, they certainly have started to reckon with that, though. I mean, some would argue, Deborah, that when you look at some of the recent Treasury auctions, at least on some of the longer dated ones here, that this is a market that still wants to see more yield. And I'm talking about for new issuance, for those folks who are going to come in and buy.
Agreed. And it's amazing to me that, with over $1 trillion worth of Treasury issuance post the debt ceiling resolution, back mid-year, you're still not seeing a Treasury curve that is anything other than flat and in parts of it inverted, from a liquidity market standpoint out to a year and then further out, to the 2-year, 3-year, 5-year, 10-year.
So, Deborah, I'm curious, and when we go back to that idea that Treasury yields are falling today and it might be due to the conflict in the Middle East, does it matter why yields are moving as long as they are moving? They've been moving higher, right? And if they continue to move higher, doesn't that just the Fed does the work is done for the Fed, and it doesn't really matter if you've got these other factors coming in?
Well, I think that the work is done for the Fed if the bond market's yields stay higher. So that's what we saw last week and the last several weeks, with the 10-year, going as high as it's been in some long amount of history. And so that's sort of what the reconciliation, I think, was with the Fed speak over the most recent days. But you've got the opposite of that happening now. Yields are going down and prices are going up. And I think that takes away some of the motivation that the Fed had for staying on hold.
At this point, what is a known when it comes to the inflation picture? We're going to get some data tomorrow on PPI and then, of course, on CPI. Is this going to move the needle in any way for the bond market?
It's too early for the conflict itself to have any real impact from an economic standpoint. Whether it's oil prices, whether it's consumer prices, those things those are already baked in the cake for the numbers that we're going to receive this week. And I think what you continue to see is, sort of a consumer that's driving the economy. Wage inflation continues to be higher. Rents, housing expenses, major retail purchases all can continue to be, higher from an inflationary perspective. And, I think what the Fed has told us is that getting, sort of from 8% inflation down to 4% inflation was a whole lot easier than getting from 4% inflation down to 2% inflation. So we started last month to see a little bit of a retracement in some of that. And I wouldn't be surprised if you see a little bit more, certainly not back into, 5, 6, 7, 8 type percent inflation in overall averages. But I think there are key sectors that just haven't reconciled with that, inflation bound being met and coming back down again.
I am curious here, Deborah, about what we're seeing on the shortest of the short end of the curve. The idea of all the people that piled into money markets and other cash-like instruments here, whether you think potentially that trade still has some legs, assuming that rates are going to stay elevated.
We don't see any reason why that trade stops. What has driven the bus from flows in money market funds so far in 2023 has been the retail trade. So retail flows have really left deposits. $1 trillion have left consumer deposits, and $1 trillion has gone into money market funds. What we haven't seen from a flow standpoint has been the institutional side of the market, which is actually a larger part than the retail sector. And generally speaking, institutional investors go into direct securities when rates are increasing because they are on the market directly, as opposed to, kind of catching up, which you would need to do in a money fund that has a weighted average maturity of 20, 30 days, something like that. Yeah. But once rates reach a peak or a plateau and start to go down the other side, institutional flows kick in. So I think there's a lot more to come on this, Romaine.
All right, Deborah, I have to leave it there. Always great to talk to you. Deborah Cunningham over at Federated Hermes, helping us count you down to those closing bells. The bell is just around the corner. Stick with us. Our full market coverage coming up right now as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast, joined now by royalty. Carol Massar and her subject, Tim Stenovic, bringing together our Bloomberg audiences across television, radio.
I was just going to say, he's the court jester, actually.
Oh, okay. Are you moving up in the world?
Did you ever see him juggle balls? He's really good at it.
Oh, yeah.
He juggles a lot of things. All right, the market's also juggling a lot of things. Definitely seeing, though, a bit of a break, it feels like. Equity to the upside. Did you like what I did there?
Yeah, she's the queen of transitions, truly. No question.
Segue queen. Having said
That's what
that,
I'm laughing at.
Yeah. Oh, wait. Are you laughing at? Are
No.
you laughing at? Are you laughing at me?
No.
Are you? Okay.
Never.
All right. I'm looking at solar stocks, guys. Have you looked at the Invesco Solar ETF? It's up about 6% in today's session. I'm going to talk a little bit about some of the names on the move, but France announcing plans to boost solar power capacity in the country, and so it looks like that sector is certainly getting a boost in today's trade.
Hey, we just had a great chat with Doug Sioka. We check in with him quite a bit over at Kavar Capital Partners. He talked to us about being on Team Soft Landing these days.
Really?
Yeah, he spoke about stable or accelerating growth here in the U.S. The consumer is still spending, even though the consumer has lost some of that leverage when it comes to, looking for jobs and lost the upper hand to companies that are doing the hiring right now. Household net worth is solid. He's thinking things are looking pretty good.
He loves that GDP Now number for the fourth quarter.
I mean, everyone loves that GDP Now at the Atlanta Feds, yeah.
I wonder if we could, there's a team no landing at this point because the data has continued to exceed expectations.
Yeah. Okay, let's walk through the numbers here.
You left him speechless, Scarlett.
On this Tuesday afternoon here. Green across the screen here with the Dow, the S&P, and the NASDAQ, both all up for a third straight day here. The Dow Jones Industrial Average higher by more than 100 points, or about 0.4%. The S&P 500 going to close higher by more than 20 points, or 0.5%. A 0.6% gain for the NASDAQ composite. And your outperformer on the day, actually the Russell 2000, putting together a fifth straight day of gains right now, 1.1% here on the day.
All right, digging a little bit deeper into the S&P 500, as I like to do. 384 names, Scarlett, to the upside. 117 losing ground today, and then 2 unchanged.
And that's kind of mirrored in the sector breakdown in the S&P 500 as well. 24 groups, 20 of them are in the green, led by autos, banks, and utilities. Of course, banks will be reporting earnings at the end of the week. And then on the flip side, you've got tech hardware, insurance, and software. So some of the big tech names, at least nominally in the red, in that the sectors are not positive today.
All right, so let's get to some of the individual gainers. Who does not like Fritos?
I don't, but go ahead.
Oh, you're the only one.
Wow, how could you not like Fritos?
Fritos? No, God.
They're
right,
good.
They're really
He
good.
likes other
on the
snacks.
tier of snacks, that's literally like towards the bottom.
All right, we got to work on you.
It's like Fritos and those Necco wafers.
Oh my gosh, Fritos are so good.
I agree with you about those wafers.
Well, the maker of Fritos and Doritos and Tostitos is up about 1.9.
Tostitos, I can go for it.
I'm glad to know you like something in their array of products, if you will. Up 1.9% in today's session. The company coming out and boosting their forecast for sales, and they said basically, right, we've heard from Walmart, we've heard from the maker of Pringles saying, those weight loss drugs, Ozempic, Wegovy, well, that's impacting what they're seeing people buying in terms of snacks and other things, maybe pulling back a little bit. PepsiCo saying, ain't happening, hasn't affected any of its snacks and sodas so far. Company is focused on package size and consumers' portion control concerns as it aims to reach its raised annual forecast. So
portion control.
Yeah.
I'm curious. We were talking a little bit earlier about what the snack community has to say about this here. And I'm curious. It's not just about portion control. If these drugs are going to be mass adopted, as most people seem to think they are, this isn't just about eating less. It's also about people going to be opting to eat things or not eat things that are bad for you, and meaning with a lot of sugar and other starches and things.
Well, there are some who would argue, and there's lots of conversations, that maybe if we just made food healthier to begin with, we wouldn't need to take drugs and all this good stuff.
I think Mother Nature's on the phone. I think she said, I've been making food healthier for you guys since
That's
the
right.
beginning
She said,
of time.
I've been doing it.
You just have to, pick an apple and, a carrot.
Yeah.
Something else.
Yeah. Or fruit.
Okay. Are you ready to move on?
Wait, yeah. I have a related stock, Celsius Holdings, if I may. Yes. If you didn't interrupt me, I'd be done. Celsius Holdings up 5.3% in today's session. It's a distribution partner for PepsiCo, which of course reported better than expected third quarter results. So anyway, this one also gained. It's about a $13 billion market cap. If you're not familiar, it's up 60% year to date, but also 25% of the float is shorted. So just something to keep in mind. Enphase, I mentioned solar stocks are rallying. France seems to be upping its goals in terms of solar power capacity. So you had Enphase topping the S&P 500 and NASDAQ 100. You can see up 5% in today's session. First Solar also rallying in today's trade. And then I just want to quickly mention Rivian, if I may. UBS upgrading the company, obviously an EV startup, upgrading to buy from neutral, citing an improved setup following recent capital raise. And that one was up 4.6%. So some big gainers today, Tim.
All right, a couple notable decliners as well. Defense stocks giving up some of yesterday's gains. starting with L3 Harris Technologies, down 1.46% today. It was up yesterday by more than 10%, giving up some of those gains. Citi did come out with a note today that said even though after yesterday's rally, defense stocks are still attractive. Northrop Grumman finished the day down by 1.4%. Also, luxury stocks slipping today. This was after LVMH reported results that showed sales slowed in the third quarter, sort of signaling this pullback on a consumer spending, at least on high-priced goods. Tapestry finished the day down by 1.9%.
You know what was so interesting about that report, though? I mean, because you're still seeing growth in the actual goods. I mean, like, you know, the purses and that kind of stuff, the clothing. But I thought it was interesting that the biggest drop was actually in like the champagne and spirits business.
So what does that say about what
I don't know. What
we're spending our money on?
I know, and we've had a lot of people on this program that have talked about that. Those are some of the first things to be cut here when consumers start to get a little worried about their finances here. You know, maybe they'll still splurge on a purse or something, you know, around Christmas or something. But as far as going out every day and drinking, Moet or whatever else they make,
they may be trading down to Modelo beer. Remember?
That could make sense.
What's Carol drinking now?
That's not a consumer staple?
Wow.
Some people define it as
I kid.
What about Ralph Lauren, though? That was another company that ended up falling on the news today from LVMH, down 1.74%. So perhaps some concerns about consumer spending in that space.
That's interesting.
Yeah.
But high end, I thought we kept saying that luxury stocks were somewhat immune.
Well, how does that bode for Birkenstock's IPO and the pricing of the IPO later on today?
Are those high end?
$100 sandals? Would you consider that high end?
I didn't know. I always think of them as
I guess it's all relative.
Biblical.
I mean, Scarlett, if you're walking around in $2 flip flops from the Jersey Shore, then yeah, I mean, $100 sandals are
Crocs aren't $100.
Well, I think Scarlett, I think you bring up a good point in that it speaks more broadly to the retail environment. Like, are you still comfortable to bring a retail good, if you will, right, that plays into this world, into the public markets? And so,
I think so. If it's a brand like Birkenstock, right? I mean, it's not just any random brand coming in. I mean, it has the brand name, it has the sales, and of course this year it's been in the zeitgeist for a variety of reasons.
And Romaine wears them with socks around the newsroom.
Only took 260 years for this company to go public.
Well, there you have it there. Stability, Tim Stenovich. We're not seeing stability in the Treasury market here. Remember, we were closed. The bond market was closed yesterday for the holiday here in the U.S.
Not a great 3-year auction today either, right?
On Tuesday, no, the auction did not do well. Look, I mean, the narrative is very simple. That overall, this is a market that wants higher yields. Now, you're seeing the yields move down today. Some of that had to do with some of the dovish comments that you got out of Fed members. Some of that, of course, had to do with the haven bid because of the Israeli-Hamas war going on right now. So you're seeing the entire curve shift down here. But I think when you look at some of the comments by Neil Kashkari just a little while ago here, I think most people assume that the trend is still to the upside, at least until the Fed maybe gives some clarity that not only are they done, but more importantly, the Treasury gives some clarity that it doesn't need to keep issuing all this debt.
I don't know if that's going to happen anytime soon, given what they forecasted. Yeah. That supply will continue to come out.
And then we'll see whether or not there are buyers. It's just a tricky time. I'm curious to see if, we get a speaker and we get some growth, and do we kind of move beyond worrying about the U.S. budget again, or the U.S. budget deficit. I'm always amazed at how it's front and center and then it isn't. And many would argue that at some point we've really got to kind of deal with this issue.
Look, on the nearer term, on the shorter term, Romaine, we get minutes from the Fed. We get inflation data this week. We get how consumers are feeling later this week. Yeah. But I'm probably most excited for hearing from the big banks at the start of earnings season, because we get to check on the consumer.
Well, and check on the consumer, and don't forget, I mean, this isn't going to be an issue with the biggest banks, but with some of those regional banks, you forget. Think about the surge in yields we saw during the quarter and how that took them off guard at the end of last year and in the first quarter. And now hopefully they learned their lesson from that crisis, but it still makes you wonder here whether they're sitting on some paper losses.
Ira Jersey gave us a fantastic anecdote earlier. He said his depositor bank is raising rates from basically 0 to 4%.
Oh, yeah. Well, it's not just him. I could share it with you. I mean, it was earlier this year. I mean, I was getting less than 0.5%. Right now, in that same account, I'm getting 4.4 or something around that name. So in just like 6 months' time, they've gone up 4 percentage points.
So do you wear Birkenstocks with socks? We all want to know.
I just wear the socks, no Birkenstocks.
To be continued. All right, guys, that's a wrap. Tim and I are heading out west, so we,
What?
yeah,
we're going to miss you.
We've got some meetings with Hollywood folks. I'm just going to say.
Yeah, okay.
We'll bring you some Tostitos.
Well, have fun out there.
They're branching out across platforms.
Yeah, you
That's
can
a
get
hint.
real tortilla chips out there in Los Angeles.
We will bring some back, maybe an In-N-Out burger too. But we'll be back with you. Jess Menton and Molly Smith are going to be here with you.
Kind of guy, but the sentiment.
I can never win. Never win.
Never win.
We'll see you on Monday, but we'll catch you.
Safe travels.
Cross-platform. Catch us beyond the bell tomorrow, guys.
And as our radio colleagues head off to California, well, California's coming to us. The CEO of the California Public Employees Retirement System, Marcy Frost, going to be joining us for an exclusive conversation about their future investment strategy. You don't want to miss that conversation. It's coming up next. This is Bloomberg. Romaine Bostick here with a look at how markets fared in the U.S. here on this Tuesday. An update, to be sure, pretty much across the board. A third day of gains for the Dow, the Nasdaq, and the S&P. The Russell 2000, your outperformer on the day, piecing together what is a fifth straight day of gains. Now, the gains are somewhat modest, to be sure, but a market that has been on edge, whether it's because of Fed speak, whether it's because of the developments over the weekend in the Middle East, or whether it's maybe some of the broader macroeconomic concerns, seems to be taking it in strides. You take a look at the TLT, slightly on the back foot here on the day, as a lot of people started to catch up after the bond market reopened today after being closed on Monday for the holiday here. And we saw a meaningful drop to the downside for most of the Treasury yields out there, 14, 15 basis points across the curve here. And you take a look at just a little bit of life that we're starting to see there in that aerospace index, which, of course, has had a pretty strong rally yesterday on the back of the conflict. Scarlett.
All right. Well, despite the drop in yields today, when you look at what's been happening so far this year, especially in the second half, it's really been a surge in long-term Treasury yields. So let's take a deeper dive into that movement. Bloomberg's Steve Ho actually saw this coming because 6 years ago, he was a PhD candidate at the University of Michigan, and he wrote his doctoral thesis predicting this. Today, he's a senior quantitative researcher for Bloomberg's Indexes team, and Steve joins us here in the studio. Great to have you on.
Hi, Scarlett. Hi, Romaine.
So in your thesis, Steve, you outlined an explanation for why yields would surge, and it's tied to supply. What did you find?
Yes, so let me actually clarify. So bond yields has been rising pretty sharply this year since July. In fact, I think 10-year yield rose about 93 bips. And a lot of people have been attributing this rise to supply. And indeed, the Treasury has been sort of issuing a lot of debt. The TBAC, the Treasury Borrowing Advisory Committee, has been, recommending, some 30 billion 10-year bonds and, similar amounts in 20 and 30 years. There's a lot of debt. What I think my thesis found at the time was that supply is only half the story. That it's not just the supply, but also the price of duration risk. In fact, what I found is that the supply has a different effect when the stock-bond correlation is positive versus when it's negative, right? Because the stock-bond correlation essentially proxies the degree to which bonds are hedging assets and proxies how markets can easily absorb the supply.
Well, when we talk about, how that balance sort of works out and supply issuance, I mean, if you go back sort of prior to, the last 20 years when we had that negative correlation here, which worked to the advantage of everyone here, when you looked at the performance in that era where you did have that positive correlation, what did it tell you?
So what you can see is that if you plot something what is called a term premium, right, which essentially is a risk compensation excess yield in which, long-term bond yield is in excess of expected short-term yields, right? And you plot that, estimate against issuance, some sort of GDP-weighted issuance, you see a straight line up, right, during the period when stock bond correlation is generally positive, which was like between the 70s and 2000. From 2000 to the present day, you see a very flattish line. Right? So basically no effect. And that is why when you generally consider the relationship, they're actually very weak.
So this is curious because you figured this out 6 years ago, or you were thinking about this 6 years ago. What prompted you to look into this at that time?
During my PhD, for sort of the years like mid 2010s, a lot of people in macro and finance were generally trying to figure out to what extent QE worked, right, and why it worked, right? Because quantity, supply, demand, it turns out in finance actually doesn't really enter asset pricing. Curiously enough, academics actually don't think about supply and demand until QE came along. But then I personally was thinking there is a monetary rule called the Taylor rule in monetary policy, but there's not a similar rule for debt policy. We have this $13 trillion, well, at the time $13 trillion debt portfolio. Today is 26. Does the way in which debt management is conducted, the maturity structure, does that matter, right? And to what extent that can actually affect asset prices, in particular, bond yields?
So, I mean, are you, when you did the paper and in your research since then here, so are you regressing that term premium? Mm-hmm. So just to take the 10-year benchmark. Mm-hmm. So you're regressing that on the level of issuance or the level of demand? So there's a difference, right?
Yes. Yeah. So of course, everything in macro is endogenous. That's to quote an academic word. What I was doing was I was taking these measured term premium estimates, whether it's coming from the ACM, the New York Fed, popular gauge, or my personal preferred Kim Wright, sort of metric, or other, so Cochrane PSAs. There are different metrics, and regardless of how you measure it, when you run the regression on issuance as weighted by some sort of maturity weighted, or duration weighted issuance. Right, you get this robust relationship.
But what's the relationship to? I just in that, and then I know we're getting a little in the weeds here, but we talk about a lot of the folks who trade at the short end of the curve, those folks at the longer end of the curve, and then you kind of have the arbitrageurs who just are looking to just make a buck anyway. Like, is there some component of those sort of individual communities that are more critical to supporting that theory?
Indeed. So what I find in my paper, the way I model is I look at these marginal arbitrageurs, right? The institutions that are sort of indifferent, are not natural habitat holders, are not the pension funds and the natural buy to hold to maturity buyers. Instead, they are the ones who are sort of trading along the curve, right? And they want to basically consider the marginal risks bonds as to the overall portfolio. And that is the reason why they are demanding a higher risk compensation. As a matter of fact, I think, since July 27th with the Fed stop hiking, 93 bips of increase, right, of 10-year yields, about the entirety is explained by term premium, right? In other words, this is a market that's skittish about bond prices falling the next day and less about whether bond yields actually over the 10 years deserves to be longer, which they do, right? There are good structural reasons why they should be higher.
All right. This was a great conversation and great to catch up with you. Steve Ho there. He's a Bloomberg senior quantitative researcher for systematic strategy indices and a great paper that he wrote prior to coming to Bloomberg that really sort of breaks down the term premium and really some of the underlying causes of why we see that activity at the longer end of the curve. All right, coming up here on the big program, a refocus on what's going on in Israel and a focus on defense stocks that have been surging on the back of the Israel-Hamas war. We're going to be joined by one of the top defense analysts out there after the break. This is Bloomberg.
When Congress returns, we're going to ask them to take urgent action to fund the national security requirements of our critical partners. The United States has also enhanced our military force posture in the region to strengthen our deterrence, and we stand ready to move in additional assets as needed.
President Joe Biden speaking earlier about the U.S. commitment to supporting Israel and its war against Hamas. We're joined right now by Anne-Marie Horton, the co-host of Bloomberg's Balance of Power, fresh from the White House lawn, now back in the Bloomberg studio here. Anne-Marie, I'll talk a little bit here about the U.S. response right now. I don't think this came as any surprise that the president would stand firmly behind Israel. But, of course, there's got to be follow-through here, both with new equipment, new ammunition, and maybe potentially more money.
Yeah, absolutely. The president came out and he was unequivocal and unwavering in that support. And he called what happened over the weekend in terms of Hamas's massacre of Israelis and others on Israeli soil. He called it a sheer act of evil. Now, what the president said that they will be doing is they're going to speed up some of those supplies of ammunition and interceptors that Israel uses for their Iron Dome anti-missile defense system. The president also said that when Congress comes back, he wants them to urgently fund the national security requests and needs of American partners. Notice the president used the word partner, so obviously Ukraine would be linked into this request, not just what is happening with Israel. But the president was pretty direct about it, that Israel has every right, and also he said he deems it necessary what Israel is doing in terms of their response. And he said if this was on U.S. soil, it would be the same, swift and overwhelming.
Anne-Marie Horton out there in our Washington bureau. You can catch her at the top of the hour on Balance of Power here. They'll, of course, have full coverage of all the developments out of Israel and the response by the U.S. government. We want to stay on this topic right now and focus in on some of the defense contractors that are going to be needed to aid this effort. They, of course, have been some of the biggest gainers in the stock market over the past couple of days. Joining us now from the Military Army event in Washington is Sheila Kahyaoglu. She's U.S. equity research analyst over at Jefferies. All right, Sheila, we kind of know already that the U.S. has been a big supporter of Israel on the military side, more than $3 billion a year in direct military aid and billions more in indirect. And we learned a little bit earlier today that Boeing actually was able to rush through about 1,000 new smart bombs to Israel as part of a previous contract back in 2021. I am curious as to whether we're going to see new contracts or expansions of some of the old contracts because of this conflict.
Yeah, I think we're definitely going to see a defense bump up. You can't see it right now, but I'm at the Army show, AUSA, and I'm standing behind a General Dynamics tank. But I think one of the recurring themes here is, combat land wars are here to stay. And the U.S., this is not a short-term bump. The U.S. is going to have to work on its restocking of missiles, munitions, and land vehicles. So that's a recurring theme that's going on here, just given the stock levels are depleted because of Ukraine, the supply chain issues because of the pandemic, and now Israel might be short of it, and so is the U.S. So it's, an 8 to 10 year upcycle is what these folks are calling for, and some are saying we could see a $1 trillion budget, so growing 6 to 7% versus the fiscal 24 budget just slated to grow 3 to 4%.
An 8 to 10 year cycle. So when you talk to folks at the event right now, what are they predicting in terms of the price action to account for all of this? Are we going to see it for just a couple of days before the numbers actually are backed up, or is this going to go on until go on kind of indefinitely as long as the headlines are there?
So it's hard to tell how long the situation in Israel will go on, how the U.S. will be involved. Clearly, when we look at Ukraine, there's been over $113 billion of funding through 2022 sent to Ukraine, with an additional $24 billion or so held up by Congress at the moment. So Israel, as Romaine mentioned, receives $3 billion of funding. That's mainly through FMS notifications like F-35 and CH-53K and Chinook, that aircraft. But obviously, that could grow higher as this conflict goes on longer. So, we're yet to see how long it goes on, what the beneficiary is. But right now, the short-term call is probably for more missiles, munitions, restocking, and land vehicles that the U.S. is also short of in its current stock.
Okay. What about the kind of the ecosystem, not just the defense contractors, but companies that, also supply to the defense contractors? How are you thinking about that?
So the other realm of beneficiaries from this would be the IT services providers. So think intelligence, cyber, software equipment, like a Booz Allen. They're having their analyst day tomorrow to showcase what they're doing with AI, not only across their defense customers, but their Fed civil customers as well. So those are the next leg of beneficiaries. Folks like Leidos, manufacture hypersonics for the DoD, for the U.S. Army. So that would also be another beneficiary. So that's in addition to software systems for the Army. So those are some of the other manufacturers we see, or software providers that we see as beneficiaries, rather than the smaller suppliers like a Mercury that we would call out.
Sheila, I have to get your thoughts before we let you go here on the commercial aviation sector. We know that flights effectively have been grounded in and out of Tel Aviv here, with some of the airlines here in the U.S. basically saying that it will be at least until the end of the month before they resume flights. Is there going to be any material impact that investors should have their eye on?
It's a very limited capacity impact. It's about 2 points of capacity, specifically in Israel. So no material impact on the airlines. One carrier I forgot to mention, one defense contractor I forgot to mention is Elbit Systems. It's actually an Israeli defense company. It was down. Shares were down yesterday, but it generates 20% of sales from Israel. They actually do ISR equipment on El Al, the Israeli airline carrier, commercial carrier. So they have ISR equipment on that. But that's probably one beneficiary that we should call out as a big supplier in Israel and also on commercial aircraft. So no commercial flight capacity impact as we're seeing it today.
Sheila, really appreciate you taking time out of the conference today to join us. Sheila Kahyaoglu over there at Jefferies. A closer look here at some of the defense contractors now being tasked to aid in the effort going on over there in the Middle East. Coming up here on the program, a conversation with the CEO of the California Public Employees Retirement System, Marcy Frost, up next after the break. This is Bloomberg. Welcome back to the close. Almost 400 of the S&P 500 stocks close higher here on the day, helping push the benchmark index to its third straight day of gains. You saw similar moves in the NASDAQ, similar moves in the Dow Jones Industrial Average and the Russell 2000. That was your outperformer on the day, up more than 1% for a fifth straight day of gains. The VIX tamped down just a little bit. So too is the dollar. So too is crude, as some of the jitters that we saw over the last couple of days coming out of the events over the weekend in Israel seem to have subsided, at least for now. Though we should point out there was a little bit of a catch-up going on in the bond market, which was closed on Tuesday, a reopening today, and you saw the bids come in fast and furious. The entire curve shifting lower, 12 basis points or so on the shorter end of the curve, 15 basis points or so here on the longer end of the curve. All right, let's turn now to public pensions. It's crunch time now for the largest pension fund in America. The California Public Employees Retirement System has a leadership vacuum after the recent departure of its CIO. This is state lawmakers, unions, and climate activists are asking CalPERS to divest from oil and gas holdings. A lot of big questions here about what happens next, and who better to answer those questions than the CEO of CalPERS, Marcy Frost, who's joining us right now with our very own Ed Ludlow. Ed, take it away.
Marcy, welcome to our bureau in San Francisco. That was a long to-do list that Romaine outlined. We describe it as a vacuum, but Nicole Musico stepping down. The search is underway. How is it going? And what is it you're looking for?
Right. So we have just relaunched the search to replace Nicole Musico, who left us at the end of last month. And so we operate in a public sector environment. We have certain processes that need to be followed. So the first step in that process is to get a headhunter who will help us once again. We will have a subcommittee of our 13-member board who will be involved in choosing the next CIO, even though the CIO reports to the CEO. And so time frame for me, the best case scenario would be slightly or shortly after the first of the year to get a new person in the seat.
But there are candidates.
There are candidates reaching out now.
Some of the investment strategy that Musico employed was interesting. Private equity, local sports teams, Sacramento Kings. How much of that continues based on what was put in place?
Well, private equity has always been a part of the CalPERS DNA. And it wasn't that long ago that we did a 10-year look back at our private equity returns and really access to the markets and pacing of that capital. And what we found is we can do better. And so the asset allocation that was approved by the board in November of 2021 actually moved the private equity allocation from 8% to 13%. What you can expect to see in November is the team coming forward with a recommendation to include an additional 4 to 5% allocation to private equity and additional 4% allocation to private credit. So even though Nicole was certainly the lead sitting in that chair, the entire team is really around an asset allocation that delivers a 6.8% return.
I want to go back for a moment just to the search that's taking place, because if you think big picture, one of the big challenges for public pension funds seeking talent is there's a lot of political scrutiny on that person and relatively low pay compared to an endowment or private asset management job. I'm curious as to what your sales pitch is to prospective candidates on why it's worth making the move to America's biggest pension fund, to CalPERS.
Yeah, I think you have to be someone who's really aligned to the mission, that we have this really important part of our world or our job that pays these benefits to 2 million public sector workers. And, frankly, not everyone is really motivated to do that, whether that is a lower pay environment, whether that's the public scrutiny of sitting in the CEO seat or the CIO seat. So it takes a special combination of skill set, behaviors, alignment of interests, and really kind of that fire in the belly that you want to add purpose to your life. And now, in the past, we've not had difficulty in getting candidates to be interested in those that environment. But the time is early, and again, we've had a number of candidates already reach out asking about the time of the process and then also who to contact to become a candidate.
So there are no conversations about the benefits of moving away from an internally managed pensions position to maybe an outsourced CIO kind of role or model?
There are no discussions about outsourcing our CIO.
I am curious, though, Marcy, about the idea, sort of, I guess, of what she had brought to the table. The idea, though, of diversifying in terms of the type of managers that you select, the idea of using more direct investment, and why there wasn't, I guess, more of an embrace of it. Was it a rejection of the idea, or was it maybe concern about the execution?
Yeah, I would say there's no rejection of any of the ideas that she brought to the table. The team fully embraced the concepts of additional private equity, more co-investments, looking at different platforms where we actually had the utility to implement. And of course, she had, a wealth of background and experience before she ever came to CalPERS. And so if there was, any thoughts about what could be done differently, it certainly was not around the continued increase to private assets, whether that's private credit or private equity, and also just how to deploy those assets in a meaningful way that will pay these benefits for generations to come. So, change management is hard, for some, but the majority of the team was really thrilled about her vision and about the strategy about how to move forward.
But how do you get, I guess, to that level, meaning making good on what you have to sort of do for the pensioners, making the pension fund whole, or at least closer to whole as it can reasonably be, particularly when you talk about performance that has not only trailed the broader market, but trailed most of your pension fund peers?
Yeah, we, being the largest pension plan, the complexity of the portfolio and the size of the portfolio, there is some limiting of deal flow, certainly, based on the size of checks that we would have to write. But you're correct, we're a 71% funded plan. We certainly want to see that funded status improve over time. That can't happen without a CIO that has a vision, that knows how to work with a team, that knows how to work within the complexity of this portfolio and manage $465 billion in assets. And there are not, in my opinion, that is a very special person.
Does venture capital play a role in that? It's interesting because the story of venture capital this year has been a micro focus on who you are going into business with, the other LPs, be they sovereign wealth funds or otherwise. And you kind of talked about the limitations you have. Do those limitations apply to being able to get into growth stage venture?
No, I think that Anton Orlik, who is the head of our private equity team, that has been part of the playbook for him, bringing in venture deals. Some of those checks can be smaller, but when you're pairing up with other funds, you can write a sizable check and still expect a nice return over time. But coming back into venture, we believe is the right strategy for the portfolio.
My New York colleagues will forgive me for keeping this local, but I want to talk a little bit about San Francisco and real estate, and actually Sacramento as well. We talk endlessly about how vacant it is or is not. But does that present an opportunity for CalPERS to come in and get some good deals in for a long-term investment in commercial real estate?
Well, anytime valuations are low on any asset, obviously we want to take a look at it. But our real estate portfolio has really returned to core properties, and we do have exposure here in San Francisco. The occupancy rate is much lower. We're having to do some drawdown in the book or write-downs in the book on those. But we'll watch this over time. The quarantining, the pandemic really caused a lot of urban strife around commercial real estate, and that has not been worked through yet. And so we'll continue to watch it. We find opportunities, we'll certainly pounce on them. Otherwise, we're going to stay really to the core of what we do in real estate.
Well, I'm going to stay with Ed's lead and talk a little bit more about what's going on in California, this push for CalPERS to divest from fossil fuels. What kind of actions, what kind of steps are you taking in response to that pressure right now?
We try to do, a lot of communication around how the portfolio is situated. We have a very strong presence and posture around engagement with companies, and those are very respectful engagements, but they're also high accountability engagements, that we do have very strong expectations around transparency around greenhouse gas emissions. We want to know that these public companies have a plan to do an energy transition, and we have a 2030 plan that we'll be presenting to the board in November that will be, done in closed session discussion initially, and then we'll be able to make that much more public. But the plan to get to net zero by 2050 with the state of technology, climate technology today, that's just not possible. So we have to really think about what are the interim steps we can take to start moving this portfolio, reducing greenhouse gas emissions, but it doesn't mean that divestment is the way to do it. We really think working with these companies, pushing these companies, holding the companies accountable to really fulfill the commitments that they're making to the investors. That's the right approach today.
Today, and with that approach, and we know that's already been utilized, what has been the response from some of those companies?
I would say the response is mixed. Climate Action 100 Plus is an engagement strategy. We have a number of companies where we have direct responsibility for that engagement, those discussions, understanding the transition plans, the business plans. And some companies, frankly, are doing better than others. So we'll watch that over time. And when I say it's not divestment today, it doesn't mean that we would not underweight or overweight a company based on those engagement discussions that we're having. But that, again, will be a part of this 2030 plan and the markers associated with that. Those are conversations we will continue to have with our board.
Marcy, it's been a little while since you've been on our television screens. I realize we had a global pandemic.
Yes.
But what have you been doing, especially since Nicole Musico departed? How has your role changed in that time, and what does your day-to-day look like?
Yeah, the team that was in place when Nicole Musico was there is roughly still in place. I mean, she did do a couple of key hires. We hired our Key of Sustainable Investments. We hired Anton Orlik, who actually is a return from Kaiser, but used to work at CalPERS. So my day-to-day is really focusing on keeping the team together, the talent management, the culture development, and really just having this team ready to go when that next CIO walks in the door and sits in that chair.
All right, our thanks there to Marcy Frost. Great to have you here, as well as our thanks to Ed Ludlow out there in our California bureau. All right, coming up here on the program, we're going to actually have a look at Birkenstock, actually getting some news crossing the wire right now. We're waiting word here on the IPO for Birkenstock. The Wall Street Journal reporting that has now priced at $46 a share. Bloomberg had been reporting that the pricing was set to come in between $44 and $49 a share. The Journal saying that 46 is your number. We're going to have a full breakdown here of what to expect on the latest IPO to hit the market. This is Bloomberg.
All right, shares of German sandal maker Birkenstock set to trade tomorrow, begin trading as a publicly listed company. And of course, the Wall Street Journal just reported that it has priced its IPO at $46 a share. So here now to join us with a look at what to expect when trading does begin is Bailey Lipschultz. He covers IPOs for Bloomberg News. At $46 a share, if the Journal is correct, that is kind of the midway between, what, 44 and 49 that Bloomberg was expecting?
Yeah, slightly below what they marketed it for, which is a notable shift from what we had seen from the other big IPOs, looking at Maple Bear, which is the operating company for Instacart, Arm, and Klaviyo, all of which priced at the top end. We had been reporting earlier today that there were expectations for it to price at the top end. So if that is, in fact, the price, it'll be interesting to see the drivers and how the market reacts to that.
And of course,
First of all, let me just say, I love you for calling it Maple Bear. But go ahead.
We're always going to say that Instacart / Maple Bear. And what we've noticed in this latest round of IPOs is there are cornerstone investors for each of these companies. Are there any cornerstone investors for Birkenstock?
Yeah, Norges Bank, so the biggest fund for Norway, one of the biggest funds in the world, is among those cornerstone investors, buying up a big chunk of this IPO. So tightening the supply for other investors to get into it, signaling a bit of kind of optimism to the market. We've seen a number of investment funds like Norges Bank. You're looking at T. Rowe Price, others in the kind of bigger, well-known investors being put on the cover, and that's driving some positive investor reception, at least at the IPO and when they're hitting the road.
Well, yeah, let's talk a little bit about what happens after the IPO, because we know some of the other names that you mentioned haven't necessarily performed as well in the secondary market. And I am curious as to whether that's indicative of the real investor appetite out there. I can understand why somebody wants to get their hands on this for the long-term play at that IPO price, but the fact that no one in the short term is willing to come in and really bid this up says a lot.
It's relatively debated, Romaine, and that's one of the things that comes up whether I talk to investors, bankers, or lawyers, is that these IPOs have been pricing well, opening very high, but then not really touching those highs. And other than other than Klaviyo, that's the only stock of the big three that are up double digits from that IPO price, and none of the three have touched those intraday highs. So a little bit of hesitancy from investors maybe wanting to get into those stocks after you see a stock opening up, 30, 40% on the first trade, which is not a sign of optimism broadly.
Yeah, all right. Bailey Lipschultz here. A look here at Birkenstock, which we're now learning from the Wall Street Journal, has priced its IPO at $46 a share. It will set to start trading tomorrow. And we, of course, will have full coverage right here on Bloomberg. We want to continue the conversation, though, about Birkenstock and the IPO landscape writ large with Nick Einhorn, Vice President of Research over at Renaissance Capital. And Nick, first, let's start with Birkenstock itself here. I feel like the setup for this is somewhat favorable. This is a well-known brand, whether you buy their products or not. Everybody knows this company. They know their name. And of course, they're riding a lot of hype from this year, from a Barbie and some other sort of pop culture moments that have really sort of thrust them into the zeitgeist here. How much momentum does that really have?
Yeah, it's definitely a very well-known brand in the U.S., Europe, and elsewhere. And what's impressive, I think, to me is that they're growing over 20% last year, about 19%, I think, constant currency year to date. And it's really impressive that they've been able to do that with very strong margins, 35% EBITDA margins. And that's partly because, they've got such a strong brand, they don't need to market extensively. I think they are planning to ramp up marketing a little bit to kind of keep that growth up. But definitely, I think it's a very solid fundamental story.
I am curious, too. We talk about one of the big folks unloading shares, L. Catterton unloading the shares here. And I guess a lot of people are trying to draw some parallels between what we could potentially see with Birkenstock and what we saw with the last big offering that they were a part of, and that was Oddity back in July. That didn't necessarily work out so well.
Yeah, it's a very different type of company. Oddity is a direct-to-consumer makeup company. They have had very rapid growth, but they're still a very young company. I think there's a risk that it's going to be maybe a faddish product, some of their key foundations and other products. Whereas Birkenstock has obviously been around for, I think, over 100 years, decades, if not that, and has a very loyal brand following. I think their average customer owns 3 or 4 pairs of sandals. So definitely, I think, a much more well-established company. So I think L. Catterton will be hoping that helps the deal perform a little better than Oddity did.
Yeah, full disclosure, I have 4 pairs of sandals and I have 4 pairs of sneakers as well. So I've got a whole closet full of Birkenstocks, which might be too much information, I just realized. You mentioned faddish. Apparel in general can be pretty faddish. Canada Goose, Montclair, Allbirds, they were all once high flyers, then they're kind of shadows of their former selves now. Nike has a proven track record. What is the story that Birkenstock is telling to convince investors that the appeal is durable, that even though it's survived all this time, that 20% rate you were talking about can continue?
Yeah, I think they're known for being comfortable. I think that's kind of always been the sort of the strength of their brand. And I think it's been a little more recently that they've kind of become stylish too, or at least, we've seen certainly since the pandemic started that there's been a trend towards athleisure and other more comfortable clothing on the fashion end. So I think Birkenstock's benefited from that. And they've also done a good job expanding beyond their core sandals. You mentioned the sneakers. I think 20% of their shoes now are closed toe, so not sandals. So they've certainly been able to leverage that brand into new models. And also they've added more direct-to-consumer marketing. So I think all that's helped them really keep that growth up. And they think they can continue mid to high teens growth, I think is what they said. So they're optimistic.
Okay, we mentioned Oddity earlier on and how that's a makeup company direct to consumer. Cava also, of course, IPO'd earlier this year. And unlike the other companies that have gone public, it's held up really well. What does that tell you about the demand for consumer-facing companies in this IPO market?
Yeah, I think we've definitely seen a lot of interest in consumer names this summer. We also saw Savers Value Village, Gen Restaurant. And I think consumers are definitely interested in, investors are interested in consumer stories that have a kind of unique growth angle. Cava, double-digit restaurant growth, very strong same-store sales, definitely a brand that, I think has captured a lot of people. And Birkenstock, I think, is similar, sort of a very well-known brand with strong margins, despite obviously how competitive footwear is. And so I think really that's what investors are looking for, that kind of unique growth angle.
I'd be remiss, Nick, in not getting your thoughts here on one of the main ETFs, of course, that everybody looks at Renaissance for, the IPO ETF and the performance of those names, of course, that have come to market over the last, I guess, year or so, whatever the parameters are. We know that that was under pressure earlier in the year, and that's now started to pick back up. Do you see a direct correlation between some of the appetite for those names that already, those newer names that already came to market, and now the newer ones that are looking to come through the door?
Yeah, definitely. Obviously, 2022 was a rough year for IPOs, and that was a large reflection of how poorly a lot of the 2020, 21 IPOs had traded during that year. And this year, I think we saw a very strong start to the year in the Renaissance IPO index, which is the underlying index for that ETF. It was up, I think, over 40% at some point. It's come down since the beginning of August, and part of that is stuff like the Fed decisions that has rocked the market a little bit. IPOs obviously tend to be more volatile than the broader market, both on the upside and the downside. And I think that's part of why we've seen those 3 big tech IPOs from last month have traded off in the aftermarket. Part of that's just the broader market environment. I think the index is down since those companies came public. So I think it'll be interesting to see how Birkenstock does in the light of that background.
Yeah. All right, Nick, great to catch up with you. Nick Einhorn there, Vice President of Research at Renaissance Capital. I learned a lot today, $46 a share, what the Wall Street Journal is reporting. I also learned the Scarlet has 8 pairs of Birkenstocks.
4 of them sandals.
I don't know what's going on. All right, folks, so stand by here. A lot more coming up on the show. We're going to set you up for what to watch, the open toe version after the break. This is Bloomberg.
Both closed toe and open toe. Comfortable.
All right, here's what markets will have their eye on Wednesday, and we start over in Morocco.
Yeah, Janet Yellen holding a news conference at the IMF World Bank meetings. That's going to take place 4 a.m. New York time.
Back here in the U.S., inflation data, including PPI.
PPI, and if you look at a year-over-year basis, it's going to be a 3-handle once you back out food, energy, and trade.
Yeah, still elevated, not quite near the 2% target. Maybe we'll get some insights out of the Fed minutes, which are scheduled to come out at 2 p.m. tomorrow. We'll see exactly what they had to talk about at that last meeting.
And we can add Fed speak to that as well. So lots and lots of opportunities to dissect the Fed.
Absolutely. And guess what? All day tomorrow, we'll be focused here on the new IPO. Birkenstock now pricing here in after hours, started set to trade tomorrow.
Yeah, $46 a share is what we've been reporting. And of course, it'll trade under the ticker Berk.
And believe it or not, Scarlet Fu, we have to go down to Washington because apparently we still don't have a House Speaker. We are expected to have a vote tomorrow potentially on that. We'll have full coverage here tomorrow with Scarlet and I. We'll be back tomorrow. This is Bloomberg.